Hit it. It's Friday, November 18th, 2022. That's right, episode 200. We made it. I'm Patrick Ceresna.
And I'm Kevin Muir. This is our 200th episode, and we're honored to share it with the host of Cuppy's Corner, Harris Kupperman. Instead of demanding market calls, we explore Harris's investment process and talk about all the things that he's learned as a trader and investor. You don't want to miss this episode. Plus, it's not all theory. Harris tells us a new short that he has not yet publicly disclosed. You don't want to miss it. It's an oldie but a goodie. Then it's time for Talking Charts with our very own Patrick Ceresna. Crayons in hand, Patrick tells us what his technical analysis voodoo is indicating.
And then we end with our segments of No Stupid Questions and Skin in the Game. And folks, we might even drink some beers along the way. So stick around. We've got a great show. Lena, hop on. What beer am I drinking this week?
Patrick is drinking Cherry Schoof by, oh gosh, I can't say this, Brasserie Das Schoof. It's a Dutch beer.
It
sounds like you did pretty good, actually.
It's Belgian.
Oh, thank you. I butchered the language.
It's
Let me just read something about this beer here. The aroma of Cherry Schoof gives pride of place to cherries. It also reveals notes of strawberry, almond, spices, and sweet port. Round-bodied, soft and delicate, Cherry Schoof delights the gourmands among us. It has a satisfying finish with a very slight bitterness.
I thought I heard sweet pork.
Port. Sorry, port.
I was literally about to comment. It has a very port wine kind of a texture to it. And it's got the sweetness of a port wine.
I'd rather mine taste like bacon.
Okay. Anyway, it's I'm going to enjoy this one. All right, Kev, let's do some side effects, bud.
All right. So the side effects, we asked for some FTX side effects, and we were inundated. So thank you, everyone that sent in some stuff. We've chosen half a dozen, and we'll talk about the other ones in the after show. But nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. Side effects of too much huddle may include the FTX wallet washouts from Jim, the genital cryptococcus FTX illis from Macro Gyro. I just butchered that one. I'm sorry. The
but it sounds bad.
The Blankenfried the Sweats by Rupert, the Pyramid Fever by Economic Defense, DLED, which is Dissociative Legal Entity Disorder, which I kind of like, by R. Anti-red rug pull burn. I don't know. My autocorrect might have fixed something there. Resonance Capital, and then my favorite, the Bahama Bank Runs by Freestyle Napper. Thank you, everyone, and we'll read out some more at the end of the show.
All right, let's get Cuppy on. So joining us now is Harris Kupperman, also known as Cuppy, and one of our favorites. How you doing, Cuppy?
I'm doing great. I started early.
I was going to say, like, on Twitter is a picture of you and a couple of your buddies already cracking some cold ones in the middle of the trading day. You're off to a great start.
Yeah, I mean, oil opened the day down forward. I figured it was just time.
Well, listen, you've been with us from almost the start, going all the way back to 2019, and it's been a great run having you on the show. Love you as a guest.
Hey, thanks. I mean, I'm amazed you guys made it to 200. Congrats.
So that was Patrick asking the question. I'm going to jump in here. Cuppy, you had a story about how we made Cuppy's Corner that we'd love to hear.
Okay, yeah. I can't believe you guys don't remember this. But anyway, Kevin, you called me up and you're like, hey, Cuppy, can you do me a solid favor? I need you as a guest on the show. And I'm like, yeah, sure, whatever. But I was on the show like a month ago. Like, don't you usually cycle guests like once a year? And you're just like, no, it's good. We'll just put you on the show. It's like, okay, whatever. It's like, when do you want me on the show? And Kevin, you're like, how about now? We'll just start recording now. I'm like, okay, sure, whatever. So Patrick jumps in, and Patrick's like, Cuppy, what the fuck is wrong with your sound? And I'm like, Patrick, I'm on the second floor of the parking garage at Target. And then Patrick, totally nonchalant's like, Lena will figure it out. She's good at editing.
And that was Cuppy's Corner was born.
Yeah.
Yes.
All right, Patrick, go ahead and ask Cuppy. Let's jump into this.
No, we got to jump into this. Like, we haven't had you on a while, but what a perfect timing to have an episode when this whole FTX and crypto. Like, listen, you when you were trading Bitcoin long, all along said, I'm long the Ponzi, right? Like, and you never once denied that it was a big Ponzi, and inevitably, once things start turning the other way, some of these foul players emerge, and we got the big one. Like, what's your take on how this all played out?
Well, I thought Bitcoin was the Ponzi. It turned out all the brokers were the Ponzi. Like, I didn't see that coming. I don't know what happens now. I mean, it's totally discredited as an asset class. I mean, it seems to have attracted all the grifters. And, they stole a ton of money. I mean, as best as we can tell, SBF literally had people wiring money into the Alameda personal account as opposed to into the FTX account. It's kind of crazy. It's like, you're funding your prime brokerage account at Goldman, and you're just sending it off to, someone in management instead, and their PA. I don't really understand what was going on, how this was all working, where all the money went. The black hole is way bigger than the 5 to 10 billion they're talking about. But I don't know what happens now. I mean, I'm a trader, and when really bad news comes out and the asset class doesn't detonate, it gets me sort of curious, I guess. And I mean, a neutron bomb just went off in crypto, and all the shit coins melted, but ETH and Bitcoin are holding together. And the Economist came out talking about how it's the end of crypto, and I mean, they haven't melted yet. I don't really know. Something gets me a little curious, but probably not going to play it.
Yeah. So, Guppy, you and I were talking about this morning. It's Kevin here. I got to think that there's a lot of guys that were short Bitcoin, whether it be on the GBTC ARB or against shitcoins. It almost feels to me like it's one of those situations like in a credit contagion. A lot of times govies get lifted, and because in essence everyone's short govies against long credit. And I'm wondering if it's the same phenomenon playing out here. What's your take on that?
I mean, it could be. There was a lot of guys playing, the pair trade, long GBTC at a 40% discount, short futures or short, actual Bitcoin, and yeah, they might just be blowing up and unwinding the trade, which is why the spread keeps blowing out. I mean, I can see what you're saying, but I thought that play was in the billions. It wasn't in the tens of billions, and here we are, and it's still holding. I don't really know. Look, I'm saying this, and probably by the time you guys press publish, Bitcoin's at 5,000, but it's holding, and I take notice of that as a trader. When bad news comes out and it doesn't die,
I'll push back a little bit on that because, typically when you have such a huge drop, there's usually that reaction, that bounce. And almost immediately after the first, drop, it went from, 16,000 back to 18,000 within one trading session after the initial drop. But really, it has not bounced at all. That was like the worst dead cat bounce. And usually something that can't even react off their lows is still being actively distributed. I still think these are still vulnerable. I mean, inevitably, everything gets cheap enough. Once it comes to that major support line of zero, the asymmetry starts to exist where you can take a play the other way.
Yeah, the pedophiles and guys that want to hire hitmen.
You and the pedophiles.
Yeah, that's who uses it. That's what it's made for. Cuppy, I just want to call you a quote here that I thought was interesting. You're talking about what a shit show it was at FTX, and this guy Robert Smith, the bond hack, had a great line. He says, after the FTX filed their first kind of paperwork in terms of that lawyer, the fellow from Enron that is taking over the bankruptcy filing, he says, this is a quote from the guy who oversaw the Enron bankruptcy. It's like a Vietnam War vet saying that the bar fight he saw last night is the worst violence he's ever witnessed.
Really,
it's such a good line. Like regardless of what you feel about it, it's like well written. It's just so funny. It made me laugh so hard.
I love how in the bankruptcy filing, and usually these bankruptcy filings are really cut and dry, like boring as shit things. And the guy who's overseeing it said this is the worst malfeasance. At least Enron had paperwork. He's like, no one even knows who owns what, where the assets are, where the keys are. Like, it was literally run by a bunch of 20-year-olds in a fraternity house.
Yeah, and you know what the funniest thing, I don't mean to interrupt you, but I do want to talk about the whole centralized and the idea of that people are now calling for regulation on an asset that is in essence a decentralized network. The whole attraction to it is that it's decentralized. You cannot have both. Like, you can say what you want about Saylor, and lots of people have said lots of things, but at least he understands that the whole attraction to it is that you can't control it and that you can't have regulation on it. And he acknowledges that, and he views that as its selling point. And yet here we have Kevin O'Leary on TV, claiming that the government has fallen down because they haven't regulated this stuff. Well, that's the whole raison d'etre of this thing from the start.
Well, I'm going to fade Kevin O'Leary every day of the week, twice on Friday. But
you're going to fade Mr. Wonderful?
Wonderful. But no, it's I think the more interesting thing of this all is that everyone needs a fiat bailout for their shitcoins.
Right. Okay, Cuppy, we got to talk about something that is near and dear to my heart. And I know you are a little bit of a stock market bear, but there's one stock in particular that you've recently climbed aboard the short side. And, welcome to the party, pal, as the guy in Die Hard says. Can you tell us about your new short, why you're short, and what your thinking is there?
I'm not quite sure, but
you own puts.
I got a pile of puts in Tesla.
Okay. And what's the thinking there? Why now? Why do you think that we're finally at the point where this might work?
Well, I don't think I ever left the party, honestly. I just kind of pulled it in. Now, look, this is, if he succeeds in what he's trying to accomplish, I mean, Elon, he's going to end up being, Toyota or Mercedes, but not at scale. He's going to earn a single-digit return on capital, and it's going to trade at 3 to 5 times earnings, like all the other auto companies. That's if he succeeds. There's a good chance he fails because Elon's insane. And that thesis got me into a lot of trouble in 2019. And the thing with it is, if you look at a big, giant chart, it's a giant 2.5-year head and shoulders. The neckline is like 175, and it looks like it's about to violate that neckline. And every other... Do you see what I'm seeing, Patrick? And so every other Ponzi asset's detonated. Everything's down massively. I mean, admittedly, Tesla's down a lot already, but I think it could drop into $20, $10, somewhere around there. I mean, he's distracted with Twitter. I think one of the funny things is that all these ESG funds had to own Tesla because it's ESG. It ended up being the largest weighting in every ESG index. Now he's pissed off all the ESG people.
Seriously? It was the largest weighting in a lot of the ESG indexes?
Well, yeah. I mean, it's what, like one of the top 10 companies globally in market cap, or it was? I mean, It had to be in one of the top weightings. And now he's pissed off all the ESG people, and one by one, he's being removed from ESG indexes. I mean, the whole reason it went up is that all these indexers just kept having to buy more Tesla as they had inflows. And now that he's been kicked out of the indexes, they're forced sellers of Tesla. While he's selling Tesla to fund his Twitter adventure, while a bunch of other things are going wrong in the world, like, I think this could really crack. And Kevin, we talked about that guy. What was his name? Yolo Korea or something?
Oh, yeah. The second largest individual, Tesla shareholder there is out there.
But he built all his wealth by writing weekly puts.
Right.
And buying calls with it, wasn't he?
I think he was doing both. A little Texas hedge for him.
Yeah.
And he was funding it with his long Tesla stock credit. Yeah, well, it was just crazy. He is completely and utterly kept just, pyramiding it into this huge pile of money.
But he ended up with a few million shares, starting with, a few $1,000s, just writing YOLO puts to buy YOLO calls. And as we all know, this goes the other direction, and there's a pain point where him and all the other guys like him are going to puke up. And I don't know where it is, but I think when this breaks that neckline, I don't think this is one of those takes a couple months things. I think it's like a 5-day cataclysmic drop 100 points sort of thing. And I own some puts. I own more than some puts.
Well,
and I don't short much.
The one thing to observe is the price action's just been so weak. I mean, the rest of the market has mustered up bounces. Even the FANG stocks are 10% off their lows, off just an oversold bounce. And here we have Tesla virtually about to make a fresh new low. It's just so weak. It's not even getting any index buying.
Right. It just keeps acting heavy. And I think that heaviness is that he's getting kicked out of all the ESG indexes one by one.
Well, and I also think he's increased the float. And I think that's missed by a lot of people. When he was
when he
sold his, he increased the float. When you're diamond hands, like, we've seen this before, Cuppy, where you see a situation like, remember when 3M owned Palm and they only floated 10%? And it was such a large number. And we all knew that if they went to sell their Palm, the bid wouldn't be anywhere near there. But in the meantime, it looks like it's worth XYZ. And I think that at least to a certain degree, there was an element of that with his float, that he was affecting it by being so staunchly holding it and not selling any.
Right. Him and the S&P index and all the other indexes, they just locked up the float. And then he's got a bunch of hodl retailers that'll never sell, and they just keep buying, and they're all on margin. I just think it's going to go the other way. It's look, I'm not a chart guy. We all make fun of Patrick. Sorry, man. And this is one that's just such a big, giant head and shoulders with such a clear neckline that I got to take a shot on Gall. Understanding that it made a big giant head and shoulders 2 years ago and then broke below the neckline and just reversed and went screaming out of control. So, that's why I'm playing with puts, because, it's kind of one of those wild stocks.
And I really think that to a certain extent, we've been a frog in the boiling water. And we all sit there and we look at this and we go, oh, it's 175 or whatever. It's off $100 from the high or whatever the numbers are. And we think that it's down a long way. But, scale back and look at the valuations and look at it versus the rest of the car companies. And I know, yada, yada, yada. It's not a car company. It's a technology company, whatever. Even put it up against the technology companies. Its valuation is massive. It was blown out of complete proportion. And I think I agree with you, Cuppy, that it could come unwound surprisingly quick. Like, a lot of these things don't leak. They detonate by, popping a bubble, and it all of a sudden comes unwound in a week. So I'm with you. And I still think there's a chance, and I know this is crazy, that he could go from being the world's richest man to bankrupt.
You mean like Ike? Like, remember that Brazilian guy, Ike?
Yeah, there was a guy that did that, right? Yeah. What was his name? He literally went from being one. I don't know if he was the richest person, but he was like top 10. And then he zeroed himself
in like 6 weeks.
Now you kind of brushed it over, but like in terms of the Twitter. But I mean, do you think first of all, how do you think Twitter plays out? And two, he's obviously distracted by this. He's certainly not putting his focus where it should be on trying to maintain this company, right?
Well, I don't know if he's ever really been focused on Tesla. He has an odd management style. He just kind of tweets at stuff, and somehow it miraculously works. A friend of mine actually coined the phrase, but he falls forward. Most guys, when they fall backwards like an idiot. And he just stumbles forward and it all works. In terms of Twitter, I think he's actually doing the right things there. I mean, 90% of the people there did nothing productive, and getting rid of them makes the other 10% of the people more productive. And yeah, if I woke up in the morning and Twitter was offline for 2 weeks, I wouldn't be surprised. But I think he's actually cleaning house there in a good way.
So, Cuppy, I'll jump in here on that. The idea that he falls forward, it's a great line. I would argue, though, that he's, in essence, so aggressive, and he was the perfect vehicle to take advantage of the bull market in technology and in U.S. big cap tech. And so he ended up almost being the poster child of this. So in bull markets, the people that are the most aggressive do the best. And I contend that that's what's happening. That's why he became so rich, because he was a perfect specimen to take advantage of this. But having said that, I think that this Twitter is exposing his management style, and as you say, that it might be a function of he's lucky. I think he's just aggressive, and I don't think it works as well in a down market. And now all of a sudden, people that have invested in him in the past and kind of he said, oh, no, it's okay. The stock's going up, so therefore I trust him, are looking at this and saying, hey, wait, this is the guy we're trusting with our money? And I think that the biggest problem with Twitter is that it's exposing him for who he really is. Just a complete, riverboat gambler that just goes for everything.
Yeah, I think there's some of that. Yeah, look, I don't think Twitter is going to be his undoing. But no, I actually think that Twitter can be cleaned up. I think it was just a dysfunctionally mismanaged company. I don't know if Elon's the right guy to clean it up, but I think he's going to win at that one. I think he's going to lose at Tesla and win at Twitter. That's kind of my gut feel.
Okay. All right. Now let's get into some more serious stuff because, Cuppy, a lot of times people, we talk to you and we ask you about different stocks and different ideas. And recently you've been doing the rounds, going around talking to a lot of people, and it's great and that you're getting all the publicity. You're no longer just one of ours. But what I thought would be interesting was instead of going and getting picks and talking about different stocks and different ideas, we talk about your process. And we talk about what you've learned over the years trading, how you've become like who you are, what makes Cuppy. So I have a bunch of questions here, and I just want to start with, you were talking about the fact that trending markets have an intermission and everyone gets shaken out at the wrong possible time. I think back to that Jimmy Jude quote. One of his bosses says something like, if you're getting on the train to San Francisco, you don't get off in Chicago. And I thought that was a very great line, and it's something that you talk about a lot. So why don't you tell us what you're thinking about that and what the mistake is that people make there?
So I'm always amazed that people can get the trend right. And remember, like, all the money in investing isn't made by buying some cheap stock and then waiting for the market to realize that, it's cheap, because the market will just disagree with you for 5 years and eventually you get your capital redeemed. The money is made by finding something that's inflecting positively and staying with the trend. And what I find so amazing is that people can identify the trend and lose money or not optimize how much money they make. I keep talking about, like, we used to joke 2 years ago when I was on the show that I was long Bitcoin. And I had friends who were also long Bitcoin, except for where I thought it was a Ponzi scheme. They actually really believed it was going to change the world and blah, blah, blah. They're the laser eyes guys. And they bought the same time I bought at 9,000, and a lot of them made no money or they made small money. One friend actually lost money at it, and it's because they buy to go up 3,000 or 4,000. They go, oh, it's probably going to drop 2,000, 3,000 because this or that. I'm going to sell it and buy it back 2,000 lower, or it's consolidating. I'm going to buy the breakout. And they had all these like chart ideas. Sorry, Patrick. And they had all these like, oh, it's overbought, it's oversold, it's this, it's that. Sentiment's really high. And you know what? I just held it. I'm just like, yeah, it could drop 5,000 or 10,000 at any moment in time. And this doesn't change my view that the Federal Reserve is printing money and this has become a bigger Ponzi scheme. They're going to inflate the Ponzi scheme. And I was just amazed at how many of my friends lost money in a raging bull market. People overthink this, and people, they try to trade around positions. They just end up paying taxes and slippage. And so that's in a straight line trend. A lot of times these trends, though, they trend for a while and then they take a pause. Let's talk about oil, because I'm having a shitty week. I caught the inflection when, not quite when oil was zero, but when oil was in the 30s and 40s on the way over 100. And I wrote it and I made a ton of money and I didn't take any off because I think it's going higher. And I knew that at some point there'd be a pause, and there's always a pause, and there's a kind of an intermission. I don't know what the right word for it is, but it pulls back, a third, half the move, and it shakes everyone out of the trade. And it's not just that it shakes all the speculators out, which is, what's happening right now. Oil goes up $10 one week and down $10. China's opening, China's shutting a city. Like, I can't even find these cities in China. Like, how am I going to trade this thing? Like, I can't pronounce the cities, but I read the same headlines everyone else does. But it's shaking out all the oil speculators. Remember us all? We weren't laser eyes. We were like
oil barrel
oil
eyes.
drop eyes or whatever. Yeah. And it's shaking them all out. Twitter's gone quiet. All these guys got chopped to bits, and they gave back all their gains. And what it also does is at the industry level, all these guys that went to their board of directors last quarter or 2 quarters ago, and they said, oil is going to be above 100. The in-house economist says it's going to be 125 at year end. This is the budget I want to go explore. suddenly their board of directors, when they meet for the Q4 meeting, the board of directors is like, hey, buddy, like you penciled in 125, oil's 80 today. Like, we're going to have to cut back on the budget. We have to pay down debt. We still have to pay the dividend, So while it resets sentiment from a trader level, it also resets sentiment from just like an industry level. Like, all these big CapEx programs are going to be deferred a couple of years. Companies they have to pay their dividend, they have to pay down debt, they have to do the other things they said they were going to do. And so it takes a trend where, yes, we could produce a lot more oil if you give us 3 years and billions of dollars. But it turns it into a 10-year cycle, because this pullback forces the boards of directors to force the CEO to stop drilling. And I don't think people understand how it's not just an equity or market sentiment thing, it's also an industry sentiment thing. And these intermission, for lack of a better word, it sets up the next big upcycle. And I'm sure a lot of the chart guys, they're going to be looking at the chart and, it makes a big wedge and a pennant, and they're going to buy the breakout. And all these guys are going to get long at like 90 or 100 after having stopped out at 75. And they're going to feel super smart for themselves, because they're going to catch the meat of the move in the next, 2-year uptrend, and then get chopped to bits again when it pulls back, in 2 years. And I'm just going to ride it, and I'm going to accept that I'm going to have some really bad weeks. And, this is one of them. And I think it's just a different mentality amongst investors. And I'm not saying there's a right or wrong way to do it. I'm just saying that when you enter a trade, you better decide what you are, because, it's one thing to, let some go when it gets above 120 because you're going to buy it back on the pullback. It's totally different if you ride it and then you sell the bottom of the pullback and then you hope to buy the next breakout. And, you decide for yourself what you are and how you're thinking about doing this, and not just let the market dictate. Like, go into the trade with a plan.
Okay. So now let's talk a little bit about your process and your risk management. So you have all these different positions, these different themes. You mentioned that you're having a tough week in oil. How do you deal in terms of like making sure that your portfolio is set up correctly, and how do you deal with drawdowns? Well, talk to us a little bit about the risk management side of your book.
You're all going to laugh at me, and I'm probably going to lose some LPs about this. I don't really do much risk management, I like
That's
to tell
not true. I actually know that you do, and you are thinking about things on a portfolio basis all the time, and you have limits obviously on position sizes and stuff. Like, talk about those things. You might view them as self-evident, and so you're saying you're not doing something, but a lot of people probably don't understand that what you view as self-evident isn't so evident for people that aren't professionals.
Got it. So when I was saying risk management, I was saying stuff like stop losses. It's just not who I am. To me, risk management is buy cheap assets that have strong macro tailwinds and go to the beach. But the way you avoid real problems, real drawdowns, is to be disciplined on your exposure. I find so many guys, they just play too big and they get shaken out either emotionally or they get a margin call. Like, it's a dumb way to play. Markets are volatile. Like, you want to be flexible so that in a day like this when oil is down, you can add if you want to. Like, you have the balance sheet strength. You don't want to be looking at your margin calculation being like, oh shit, $2 more and I'm going to be liquidated. Like, that's a wrong way to approach a market. I'm capped at 150 gross long. I think it's a good upper limit for what's prudent. I'm usually in the 115 to 125 range. A little margin's good. A lot of margin is disastrous. I'm 35% in any one sector because anything could happen to even the most bullish sectors. I'm 20% in any one equity. Even the best companies still end up being frauds. Stuff happens. Like, you don't want any one trade to take you down. It's a portfolio approach to investing. And, I was super bullish on oil this spring, and here we are, and there's a reason why, having position caps is good, because I gave some back. But I mean, imagine what my year would look like. It'd be a train wreck if I was playing, 50 or 75% oil versus the 25 or so that I was playing. And, it's just really useful to be flexible and have balance sheet strength. I'm sitting here, I'm about 100 long. Like, if the market crashes, I could put 2,000 bips to work immediately almost, and take advantage of the pullback, where I think a lot of people are over levered right now. And on a move down, they have to degross, and they're going to be the ones selling to me. Like, I don't know how you run a book like that if you're going to be selling on the way down and buying more on the way up. It makes no sense.
Yeah, I always ask people whenever they're nervous about a position, I say, is it going to, when it goes against you, what are you going to do? Are you going to be selling because you're nervous about it? Or are you going to be, okay, I feel good about it, and in fact, I might even buy more? And I always say, you highlighted exactly what I always say, that when I have a position I feel good about, even when it goes against me, it doesn't bother me. And the moment it bothers me is the moment I know that position's too big, or I don't actually know what I'm doing about it.
Yeah, exactly. And, you always, can play games around your position, sell some calls, earn a little bit of yield. And then, that inevitable pullback, you have a bit of liquidity to add some more. And it's just, you want to let the market work for you. I feel like a younger version of me would show up to the market every day and be like, I'm going to make money today. I'm going to do this. I'm going to push this. Now I sit here literally playing, video games on my cell phone, waiting for the market to give me money. And, when something feels oversold, I wait another 2 days. And, I wait for it just to be blazingly obvious. I don't press anymore. And I feel like, a younger version of me would be pressing, and then, it'd drop another 10%. I'd be like, oh, that was dumb. Now I have no, capacity to buy anymore. I already, it's like a general, think of like a Napoleonic War general. The good general keeps troops in reserve. He slowly feeds them into the battle, and he's waiting for that really that right moment where he makes the big flanking maneuver and just knocks the other general out of the game. And that's how you want to be. Eventually there's be that obvious thing where it's like, okay, now that's the bottom.
Yeah.
This cathartic, big tail down, and they reverse it. It's like, okay, I didn't get the exact low, but we put in a big plunge low, and it just feels right. And that's when you commit all your troops. Otherwise, you're buying 5,000 shares every dime down or something just to scale in, and you have to think of yourself like a general here.
Well, that's a great point. And actually, you remind me, I think it's Jim Rogers talked in Market Wizards. He said that a lot of times I just wait for the money to be lying there on the floor and I just go pick it up.
It's a lot like that, actually.
Yeah. And listen, we've had a show, friend of the show, Morris Sachs. He talked about how he ran a trading desk. He was the head trader for Greenwich Capital, and he said that his biggest problem was that they would overtrade. And so what he did was he put on TV shows in the trading floor to stop them from overtrading. So they would watch movies. The guy literally knows every line to Old School, by the way. I did a very obscure line, and he responded with the proper response. I was like, oh, you really did watch that a lot. Okay, let's talk about something else, Cuppy, in terms of, let's just say that emotions are running high recently between a lot of different groups, whether it's long, shorts, dollar bulls, dollar bears, left, right on the politics side. And one of the things that always kind of amazes me is how we become so charged and how people are so upset with the other side. And I've written that piece, obviously, seeyouinthemachine.com, where I talk about how, as a good trader, you should realize that you need somebody to trade against. And I use you as the perfect example of somebody I consider my good friend. I love trading with you. Right now, you're leaning more short. I'm leaning more long. You think about our politics, you lean more to the right. I lean more to the left. Yet we can still be friends. We can still have civilized discussions. We can still learn from each other. Are you as disappointed as me that everyone takes everything so personally and it's this one versus the other as opposed to just learning from the other side?
Oh, yeah. I mean, the world's just gone stupid, and I think social media is largely responsible. It's the old Mike Tyson line that, what was it? If you said that to a man's face, he'd punch you in the face. But you could say anything on Twitter. What was the line?
It was something like that, right? Yeah, the things like that. The other thing that amazes me about traders, especially, is that Stanley Druckenmiller talked about how he got 60% right over his career. That means he got 40% wrong. I'm no Stanley Druckenmiller, so I got to be less than 60%, which means I'm going to get a lot wrong. So why am I so sure about anything? Which is the answer is I'm not sure about anything. And Steve Cohen said the same thing. He says he's 55%. Yet I go onto Twitter and I find people that are 100% convinced that they know all the answers, and they're more sure than Steve Cohen or Stanley Druckenmiller.
Well, I feel like Twitter is this funny ecosystem because the vast majority of the people on Twitter that are active on Twitter have some product to sell you, whether they're launching a newsletter or a hedge fund.
Oh, those bastards, by the way. Or the ones doing the hedge funds.
Or run some podcasts.
So, I mean, they have to be confident. They have to prove that they know what they're talking about. And, then they, like, when they get it wrong, they just delete all the tweets.
Yeah, but see, I would argue that that's actually not the case, Cuppy, because you're the first one. You're running a hedge fund. You're the first one to say I got it wrong. You'll admit it. Same with me. You're running a hedge fund. You're trying to sell, subs or what? Not subs. You're trying to get LPs. I'm trying to sell subs, even though I barely try. It seems like a lot of times, I feel like you're better off just being honest. A lot of people just want honest because they know. Listen, let's put it this way: real investors, real traders, people that are not just going to be fleeting, and you're going to be able to develop a relationship with them much more so if you're honest, and because people that know this game know you're not right all the time.
Right. I mean, well, being honest is almost always the best policy. And, for me going on Twitter, it's kind of like this discovery of the truth in a way. Like, I don't need to convince you to buy the stock. I mean, the stock's going to go where the stock goes based on the fundamentals of the stock. Like, I don't have to sell you on it. Like, I couldn't care less if you buy it or not. What I want is someone in the comments to tell me, hey, Cuppy, you're a fucking moron. My brother works at the company. This is what's really happening. Like, right. That's why I put the time in. And, when you get it wrong, you're like, yeah, that weird guy, doesn't agree with Cuppy 924, whatever. He was right, and give him props. He knew why the trade was wrong. And, that's kind of why I go on Twitter. I just want to learn. I want to be told what I'm missing. And, for every time I'm buying a share, some guy's selling me a share, and he might know something I don't know. And that's kind of what I use Twitter for, and why I'm on Twitter, and why I'm active on Twitter. Like, I don't really care how many followers I have, and I don't really care if I sell subscriptions or not. Like, it's not going to change my life. But, getting one of my core themes wrong would change my life. And so I want to know what I'm missing.
Yeah, no, that's a great point. But the other point is that you're not taking it personally. You're not sitting there arguing and fighting about stuff. And I find it so tiring, the amount of fighting and like it's just I know you just kind of turn them off. You're like, okay, that guy wants to fight. I'm not going to bother fighting, and you turn them off.
Oh, I just block them. I mean, the worst thing you could possibly do is argue with an idiot with 7 followers that doesn't understand what you're saying.
Or even worse, an idiot with 80,000 followers. Okay, let's talk about your big formative trade.
I'm not going to talk about who that is.
Let's talk about our big formative trades that shaped you as a trader, okay? I noticed recently you're leaning short. Or let's put it this way: at the very least, you're less invested than you usually are. Okay, rarely do you go short, and I was just wondering why that was. Was there something in your life that occurred one time? Like, what were the trades that you think back on that really shaped your position, how you take positions today?
So on the short side, there's 2 trades that, like, I still have nightmares about, like true PTSD. And as a result, you learn that you can lose many times your money on the short side, and you could be totally right about the trade. And it doesn't matter because stocks can trade anywhere, and you have to either post more collateral. And the crazy thing is, like, a 5% position that triples becomes a 15% position. And then you're literally having to either post more collateral and it gets to be a bigger position, or you have to cut it back. And it's just the wrong way to trade. And I've had a few of these multi-bagger against me. I mean, one was this company called Chap Steel. It was a spinoff. It did something with steel that went into high rises. And we had a building boom in 2006 and 7 in condos. And I was short the housing cycle. So I was short Chap Steel because this is a business that for 20 years had made no money. And they spun it off with a ton of debt just to get the debt off the balance sheet of the bigger company because they finally had positive EBITDA for the first time in 20 years. And the thing just printed money for like 18 months. And the stock went from like $20 to $300. And it was like a 2% position that ended up being like a 20 or 30% position. And it was just like the most miserable thing. And I'm just like, you guys don't realize, like, every condo project in South Florida is stalled right now. Like, no one's even paying these guys. Like, their receivables blew out, and it's just like they're reporting earnings. The insiders are all dumping, and no one's paying these guys. And this thing got to this massive thing, and it eventually went bankrupt about 18 months later. Wow. but on the way up, it just caused me so much angst, and I kept cutting the position back. And by the time I won on it, let's say I had like 100,000 shares. I was short at like 20. But by the time I won on it, I had like 5,000 shares left, like 10,000 shares. I kept cutting it back. Like I left millions of dollars on the table, like not just on the table, but I lost, like permanently lost. And the other one was Research in Motion, where I used one of the first new iPhones. When the first ones came out, and I'm just like, oh, this is so much better than a BlackBerry. Like no one's ever going to use a BlackBerry again. And the thing is that all the guys in New York were sending themselves emails with BlackBerries. So everyone's like, oh, BlackBerry's the end. And I'd be telling these guys in New York, and they're like, no. I mean, the iPhone interface sucks. Like, no one wants to use that for an email. Look at all these little keys we have. And then, 5 years later, BlackBerry doesn't exist and iPhone's massive. But in the time that I noticed that Research in Motion had a legacy product, to the time that it topped out, the stock tripled. Yeah. And I was short, and it was a massive position. It was like a 15% position. Like, I lost tens of millions short that. And, between those two in 2007, I just said, okay, shorting's not for me. I'm not very good at this. I get the trend right, but my timing's wrong. Whereas on the long side, you get your timing wrong and it drops by 30%, you just buy more. It's just such a better way to make money. And so I have this weird PTSD from it.
That's a great story. I didn't know that Research in Motion. I do remember as well that there was a point when they came out with a tablet, and it was just like a piece of shit. And the market went crazy about it, and it was that was probably the top, if I remember right. And it was a terrible operating system. It was a terrible product. One of the founders had already checked out, and I was with you. I was like, I can't believe this thing keeps going, and it just did and did and did. And it's actually one of Canada's like that. It's one of Canada's like it was a success story that should have been a real success story. It was Steve Jobs ate our lunch on that, and it's a real shame.
Agreed. And it's amazing that it took until the iPhone 3 before it peaked out. Like there were already millions of these things in consumers' hands, and you just go call up, cell phone stores. Are you selling any BlackBerries lately? They're like, no way. Yeah. Who wants a BlackBerry? Everyone wants an iPhone. Yeah. Like it was so obvious, except for this little clique of Wall Street people that owned all the shares, and they're just like, oh, the Pearl's coming out. It has this little nipple thing they called it. Like, isn't this cool? Like, there's a little nipple in the middle. It's just like, what are you guys talking about? And they just kept buying the stock up. And so anyway, I have severe PTSD, and that's why I really can't short.
What's the nipple thing? I don't know this story.
It's a little button.
There's this thing called, it was the BlackBerry Pearl. And, there's a little like rolly thing in the middle, so you could like scroll around,
So is that kind of like the IBM thing that had that little red thing in the middle of the keyboard, and it was just as hard to get right as what a lot of people compared it to?
I don't know that thing, but I just remember there's like this little ball you kind of roll. Anyway, that doesn't matter. I mean, it doesn't exist anymore because the product.
All the dirt bags know exactly where the mind is in the gutter. Anyway, okay, let's keep this show clean.
Okay, yeah. Okay, Cuppy, here we go. Next question. You can have lunch with any trader, investor in the past or present. Who'd it be, and what would you ask them?
I'm gonna go with Jay Gould. Just off the cuff. I mean, he was just such a gangster, and he just saw the world differently, and he was such a creative, out-of-the-box thinker. And, it's kind of funny because, I read the Vanderbilt book actually twice. I thought it was a great book. And Vanderbilt's, very proper. He's New York high society. And, Jay Gould just ate his lunch over and over. I got to tell this story because I just love this story. They get into this price war because Vanderbilt has a railway and Jay Gould has a railway. They both go to the same place, and they got this price war going on. And Jay Gould just keeps undercutting Vanderbilt, and they're losing like fortunes. They take it way below the break-even cost. They keep cutting costs, and Vanderbilt's just like, I'm gonna keep my market share. I'm gonna keep my market share. They take the cost down so low, and Jay Gould's like, nah, fuck it. He buys a bunch of cattle and ships them on Vanderbilt's railroad. And it took Vanderbilt like 6 months to realize that. But Jay Gould was like quoting a price, but not actually running any trades at that price. He was just quoting a price so he could ship cattle on Vanderbilt's railroad.
That is such a gangster move.
But I love that sort of like out of the box thinking because, most people approach problems like head on, and head on rarely wins. You have to kind of think around corners and, think a problem through. And, he's just like a super creative trader.
So that reminds me, I'm going to just take a little detour here, and I'm going to tell a story that I like. It's during the Norwegian oil boom. So there was, for those who don't know, there was this oil boom when they discovered oil off the coast of Norway. Everyone that was out and they were buying, tracts of ocean to do some drilling, and everyone was excited. A huge boom. And everyone's, the prices are going through the moon. Everyone's doing that. Most traders are focused on that. One smart guy, he starts buying all the Norwegian art. He just because he realized that when all these people made their money, they were going to come back and they were going to buy the art. Because when they're, millionaire, billionaires or whatever they are. And so it ended up being a much better risk reward trade than, competing with the obvious one. So I completely agree with you that you always have to be looking for the non-obvious trade out there. And I think the Jay Gould and the Norway offshore art buy is an example of that. Okay. Here, this is my next question. In Toronto, there's a radio jockey that used to be in a band. Most people won't know the band, but anyways, he has this he does the afternoon radio drive home slot, and he has this kind of piece, or I don't know what you'd call it, a slot where he talks about. He says, "Damn, I wish I wrote that," and he picks a song. And he talks about the song, and he ends up playing it on live, like on the guitar. And he says, "Damn, I wish I wrote this." And he starts playing it, and goes, "It's a great thing. It's on Q107." And I was wondering if we made a "Damn, I wish I traded that." What would be yours? Like, what would be a trade that you look like? Obviously, you just named one with Jay Goulding and the cattle, but do you have another one, a more recent one, something that really impressed you that it was like, "Damn, I wish I had traded that"?
I'm really pissed that I didn't make money out of the Japanese yen JGB trade, because it was a risk-free, well, not risk-free, but it was like a really obvious pair trade. We talked about it in multiple issues of Kedem, and we're like, one of these is going to give, the other one's going to be a constant. And it's a very high probability you're going to make money. You could play it with a ton of leverage. It's futures then we never played it. We talked about it. My team and I, we talked about it. And we just, for whatever reason, we just never put it on, and it worked fabulously. Yen trended for 30 figs, and JGBs didn't trade at all, and it was just like a perfect trade. And we had it, and we didn't trade it. I don't know why we didn't trade it. I still don't know why we traded. We still laugh at ourselves for not trading it.
Well, there you go. That's why people have to read Kedem to do the trades you're not doing. Okay, when you look back at your career, what portion of the returns were from picking the right stocks versus picking the right themes?
You mean picking the right themes?
Yeah, or macro, or direction of
themes. Yeah, everything is themes. All my best winners were because you had a massive macro tailwind to something, and then you chose the right stock in the tailwind. And if you chose the wrong stock, you made 5 times your money, and if you chose the right stock, you made 20. And making 5 times your money in a flat market is still really good, but it's getting the right themes, always. And then when the theme goes wrong, getting the hell out of the way fast and getting out faster than everyone else. I'd say that, and you're probably going to ask me this, but the biggest mistake I've ever made in my career was saying, "Oh, this is really cheap," and the tailwind's ending, but this is really cheap. I can't sell it because it's so cheap, and then it drops like half.
Cheap things can always get cheaper. That's the crazy part, for sure.
Right. Okay.
Exactly.
How has your trading investing evolved over the years? I think you touched on this a little bit, but maybe just kind of hammer it home how you changed as a trader or as an investor.
So when I first started, I didn't have much capital to play with, and I didn't know any better. So I bet like 100, 200% of my capital on whatever thing I was doing, and I was all in all the time. And I'm still amazed I didn't blow up. There was some really near-death experiences, and over time, I've just taken the exposure way down, because almost blowing up every day of your life means one day you will blow up. And I think back to me being a trader, like sitting in my fraternity house, rocking beers. I don't know if we've ever told this story, but I used to be really friends with this guy at Cantor Fitzgerald, and he did a ton of these block trades, and there came a time where I stopped even asking the question of what's the trade? It's just like, "Hey, Cubby, we're putting this thing up, $2 in the hole. Do you want some?" "Yeah, put me in for 20,000 shares." I didn't care what the ticker was. I just knew that it would be like some cleanup print on some pension fund, whatever. And I started playing these bigger and bigger because they always worked. And 3 days later, you'd sell it, and if it was $2 in the hole, you'd sell it, up $1, and you gave him his commission, and I made 75 cents, whatever. And it was just like a risk-free, high return on capital trade. And so There's one time we start doing this 50% of my capital, 100% of my capital, 200% of my capital. And we do this healthcare stock. And it's like 200% of my capital. And it's like really in the hole. It's like $10 in the hole. So that's why I sized it up so big. And he's like, oh, yeah, it's some dumbass pension fund. They don't know what they're doing. Like, he took on a bunch. I took on a bunch. And we hit this block. And like 90 seconds after it prints, the stock halts. And I'm like, oh, shit. Like, I knew exactly what it meant. And it stays halted for like 2 hours. And the news comes that the FDA, the feds have just raided the headquarters, and the CEO is taken away in handcuffs. And I'm thinking to myself, oh, God, my career is done. I'm going to have to go back to cleaning pools. I'm like 22 at the time or something. And, thankfully, the stock opened, down 30%, and it rallied a little, and I blew it all out. And I took the loss, which was, if it was opened down 30%, I sold it down 25%. I lost half my capital. And 3 days later, the stock was zero.
Okay, so I have so many questions. First of all, the idea that you are sitting in your fraternity trading blocks with Cantor just cracks me up to no end. Okay, that's the first thing. But the second thing is, how did you know that you should sell it? Because a lot of people faced with that sort of loss would have hung on. Is that just instinct or experience at that point?
I knew the trade was wrong. I mean, I was in this trade because I thought some idiot pension fund was, blowing something out at the end of the quarter. And, now everyone puts everything into the VWAP machine. It used to be, and this was like in 2002 or whatever, guys would literally just do a block. They'd call Cantor and be like, yeah, I need to hit the golf course by noon. Like, give me a quote on, 2 million shares of this.
Yeah.
And so Cantor would just quote him in the hole, and they'd take some in the book, and they'd give me a little piece of it because, it was above their risk numbers. And I just had this guy at Cantor that kept showing me these things because I literally just paid more commission than anyone else. So I got to see him. Plus, I never said no, where everyone else is like, I got to do 2 days of work on this. And Cantor's just like, yeah, I want to, we're doing 1 million share print. Like, we're keeping 500 in the in-house account. And I want to lay off 500. And I'd be like, I'll take 250 of them. Like, I was the only one who didn't ask. So they always gave me the call. And I got to say, like, I cleared my capital really fast. Like, I didn't have a lot of capital to play with. And, a couple $100,000, became, like a lot of money over like a year of doing this because 99% of them worked.
That is such a funny story. I still can't get over that you're sitting there in your fraternity in between beers trading blocks.
Yeah, but look, I actually literally met this guy at a bar in Manhattan, and he's like, I'm a block trader at Cantor. I'm like, whoa, that's so cool, man. And he's like, do you want to open an account with me? I'm like, you realize I have like $300,000 in my like brokerage account. He's like, that's fine, whatever. Like, compliance will waive it. So I like the first trade we did, like I put like $500,000 up, like my 300,000. He was like, okay, that's okay. Like it just kept growing together. And but anyway, he got nailed. I got nailed. He wrote it down. Like he wrecked his whole year. I just blew it out immediately. I just knew I was wrong. And like I said, 3 days later, the stock was basically zero. Like my whole career would have been different. It was a real wake up call for me that, you can't, be all in all the time. It's, you should never be all in.
Right.
But, you need to have some scale and some perspective in a book. And, you don't have to make 10% a day, like trading blocks.
Okay. Now, in this next part, I'm actually very curious about because over the years, I've met a lot of good traders and I've met a lot of good investors. But rarely have I met folks that are both. And I would say, Cuppy, that is one of your biggest strengths is that you are both. And I was wondering, how did you manage to become good at both? Because I would say that they are very different skill sets. And do you think that most people should focus on one or the other?
Definitely focus on one or the other. You can't be both. I don't think I'm both.
You are. Don't give me that shit. You're that. You're sitting there day trading ARK or whatever, and then at the same time doing big macro themes. You're mixing time frames, and I've seen you do both. You're outstanding at both. And I know that sounds like I'm sucking up, but the reality is that I tell everyone you're one of the best traders that I've ever had the privilege of talking to, and it's true.
Honored.
You are good at both, and I was just wondering, how did you become good at both? Was it just working really hard, and how do you keep them straight in your mind? Like, because a lot of people struggle with both.
Straight in my mind sometimes. Let me start by saying that I'm a trader first. I'm not an investor. I'm a trader. Everything's a trade. It's just a question of time frame. if you're putting on a trade because you want to make 20 cents intraday, that's very different than if you want to ride a macro trend for 5 years. But in the end, everything's a trade. And if you're an investor, you say this thing's really cheap. This is why it's cheap. We've done the most research. I've listened to the most Tegas calls, whatever. Like that's not me. I don't even have a Tegas account. Everything's a trade because I can wake up in the morning and say, hey, wait a second, this doesn't make any sense anymore. I could blow out my whole position by noon. And I could have been 2 days earlier telling everyone why it was the greatest idea. And some new data point comes out and I'm just like, nah, I'm just out.
Right.
And I'll call up my trader and be like, it's funny actually. Cause like if I like a trade and we're going to take 10% of the position off, I'll work the order. If I'm just like, there's no way, like I just want out of this thing by the end of the day, I give it to my trader and be just like, get me out. And I know they're just going to mash the thing, but you want to come in the next day with a clean head. You don't want to have, 2/3 of the position left and try to justify why you still kept it. But no, you got to be a trader first, and you need to think of everything as a trade. And then, you as you put a time frame around stuff, you need to use fundamentals because fundamentals drive anything that goes more than a few weeks or especially a few months. And, I don't think we do the best work here from a fundamental standpoint. A lot of my friends do much better work, but I think we get the trends right. And getting the trends right is getting the trade right.
Oh, that's good. That's really wise stuff. Okay, how do you deal with, you're saying that you had a bad day today. How do you deal with down periods?
Oh, I mean, it doesn't impact me at all.
Clearly, you started drinking in the afternoon, so it's got to be.
No. Look, as long as like the stuff that gets me pissed off is when I put a bad trade in and I do something like totally rookie. If you revenge trade, and we all do it sometimes. If you do something that's really rookie, like you get chopped up, like you sell the low and you buy it back on a bounce, you sell a new low, like that sort of stuff, like rookie stuff, like I'm pissed at myself because I know that I made a dumb rookie mistake. If I have a bad trade and, a bad CPI number comes out and the market moves, 5% in an hour and I'm on the wrong side of that, well, that's just life. I played the probabilities. I guessed wrong and I'm going to live and die on the probabilities. And, if you don't blow up on the trade, which I didn't, then, you're going to live and die on the probabilities and the odds are probably going to be in my favor. And, I tell all my LPs, and I think this is really important in terms of how I frame the world, that roughly every 18 to 24 months, we're going to have a down 30. And, that's part of my expectations. And if you start the conversation with saying that's part of my expectations, then having a down 30 doesn't freak you out.
Right.
I have a lot of friends down 10 and they're absolutely freaked out because they told their clients they wouldn't be down 10 because they're going to run delta neutral or whatever they made up. And they're freaked out down 10. I mean, down 10 is just a bad week to me. And it's just, framing the conversation and expectations.
All right. So, Harris, you actually beat me to my next question, which was, what do you consider mistakes versus calls that didn't work out? You highlighted the rookie kind of making a mess, flailing around in the market. Are there other ones that you consider mistakes?
Yeah, getting too big too soon. I'm an inflection investor. Most of the time I'm looking at something that's been in a very, very long base and it's just no one cares for a long period of time. And it starts, poking its head up out of that base and you start chasing it because it's telling you something. Sometimes, you're just buying something that's in total free fall. And, sizing up too fast, too soon that you can't size up and lower your basis. That's another mistake I just make too often. Like, I'm so right. I know the answer. And you know what? I mostly get them right, but it can drop another 20 or 30% before, I get back into the green. And if you size up too fast, like you don't have the flexibility to, maneuver. And, it's just a bad mistake. I just can't get out of my own way on sometimes. And, there's a lot of these things that I do to myself. You have to remember, most of investing is really, really easy, okay? You buy a cheap stock that has a strong macro tailwind and you go to the beach. It's so damn simple. The problem is that people really complicated it because if they told their clients that that's what they did, well, their clients would just do it themselves, And so you have to make it more complicated, or you have to trade around it because you don't want to have any pullbacks, or you don't want to have any volatility, or you don't want to do this or do that, and in the end, Buffett got so rich because it's his own money. Everyone else comes along for the ride. He sits there in a ton of cash, and about once every 5 or 10 years, something is just really too cheap, and he buys it. And He's just like that liquidity provider, and that's his model, and it's an amazing model. But if you had a hedge fund and said we're going to be a liquidity provider and we're only going to basically allocate capital once or twice every decade, you'd never raise capital. And it's just so amazing that he could build a model that allows that. Whereas most hedge funds, if you don't do anything for like 2 weeks, your clients are like, "What are you doing? Like, are you on vacation or something?" And it's just people have built these walls in front of them that make them inefficient at what they're trying to do.
All right. What do you think about most retail traders or investors? What do they not realize about trading that professionals know is self-evident? Like, what is...
That's interesting. You know what's really interesting is that for my entire career, I never saw the retail guys win. The retail guys would always win for a few months, a few quarters. But the retail guys never won. Maybe in a few select stocks like Tesla, or my mom bought Apple like 5 splits ago, so she's winning. But the retail guys don't win. The retail guys always win a little and then they lose. And the professionals always win. And I don't think there's been a time in history where the retail guys have won, and then in 2000 they started winning. And they started really, really winning.
You mean 2020?
Pardon?
Do you mean 2000 or 2020?
Sorry, 2020.
Yeah, okay, yep.
All the institutional guys sold and got short, and the retail guys just bought it. And they didn't know what they were buying. They didn't know why they were buying. They just kept buying it. Yeah. And they ran everyone over. And the retail guys won, and the institutional guys got caught short and lost. And I think a lot of the retail guys cashed out near the top in 21, and they've been on the sidelines. Yeah. And it's just kind of interesting to see the institutional guys, get wrecked for the last 2 years, almost 3 years now, where the retail guys have been the winner. But what the retail guys don't know, I'm not really sure. I mean, the markets don't really run on fundamentals anymore. They run on trends and fund flows and all this weird stuff that hasn't mattered before, but ETFs screwed it all up.
Okay, Kev, I'm going to just ask a question here. Like, do you think, because it obviously really has been in the last couple of years, but do you think the fact that retail is kind of herding onto these social media places, that they just become an unstoppable force because they simply all start doing the same thing at the same time? Like, could that have contributed to the fact of why retail worked this time around?
Yeah, I think it's part of that. But I mean, the most amazing thing was that at the bottom in 2020, in March, in April, retail just showed up in huge size and bought everything in sight. They literally bought everything with a CUSIP, whereas institutional guys sold and went short at the bottom. And I don't think that was social media. I just think people like buying the dip and they're preconditioned. And from there, they kept losing. I was actually having a conversation with a friend of mine, it was about a year ago, and we were talking about this thing where retail is winning and pros are losing. And he's an old timer, like an old time market guy. And I said, when has this ever happened before? And the only time he ever could think of that this had happened was when all the pros tried to corner silver, bunker hunt. And all the retail guys took all their silverware out to the smelter, and then they sold all their silverware at 50. And he said that there were lines. He said he got short silver because he saw lines at all the silver dealers, and he thought they were guys trying to buy silver. And he started talking to these guys, and they all had duffel bags of plates and bowls. They were all selling their silverware because they couldn't believe how much their cupboards had a monetary value. I mean, silver went from, 5 to 50? And they're just like cashing out, selling all the plates. And he said that's the only time I've ever seen retail just overwhelm and beat the pros.
Okay, here's another question in terms of retail. What advantage do you think they have over professional traders?
Well, they're playing with less capital. They're just nimble. I mean, try moving around when you get bigger. It's impossible.
Why don't you talk a little bit about that? And then, for example, how has having more capital affected you?
So we're almost 200 million of capital here. And, there's things that we just can't do now that, when it was my own money and it was a couple $1 million, we could do, we'll still look at small companies, but, that world of under 100 million, I mean, I'm not going to say we won't touch that, but I mean, you look at it and you say, that's great. But if we don't buy $5 million worth, why are we going to spend the time learning this thing? And the worst thing you could do is buy 200,000 worth. And then you're just and you can't get any more. And it's oh, great. What am I going to do with this position? I spent, a month learning about it. And we kind of believe in it, but I don't really want to keep up to date on it. And yeah, you have this weird thing where it's almost chicken and egg. You don't really want to research it unless you think you can find a block. But if someone shows you a block and you don't have the research done, you can't buy it, and that block might be gone tomorrow. And it's just it forces you into larger companies where I think a lot of the great opportunities still are this under 100 million world where just no one's poking around. And I just think there's just huge opportunities. I mean, if I was going to start again and, I had some, pocket savings, I wouldn't own anything above 100 million market cap.
Okay. A lot of times you get interviewed. You're in demand because you're so fun and you got great things to say. What is the question that afterwards you're always like, I wish, the interviewer should have asked me this, X, Y, Z?
Never really thought of that.
Like when you come out of it,
I don't know.
Like, what is the thing you feel like that people should be asking that they're not?
Well, everyone just wants like a stock pick, and I don't think that's. I mean, look, that's the thing that people want to talk about because it's like actionable and fun. But in the end, like stock picks come and go. Process is the important thing, and no one ever wants to talk about process because it's boring. It's like talking about the emotions of being a trader. I remember being, a 20-year-old trader, and guys like the old timers would talk about the emotions. I'm like, dude, what's the emotions? Like, you buy a level, you sell a level. Like, let's talk about charts. Let's get the crayons out. Let's talk about rips and dips and all this other stuff. And they're like, yeah, it doesn't matter. Like, there's always another trade tomorrow. Let's talk about emotion. I didn't understand that until I got to be 40, and I'm just like, oh, it's all about emotion. Like, you got to be zen, otherwise you can't be thinking. No, it's all about process, and no one wants to talk about process and the fact that a process is repeatable. And like I said, I show up to work some days and I'm just like, yeah, let's dump this position. And it was a 10-15% position. There's no news. I'm just like, nah, I woke up in the morning, didn't feel it anymore. It's like, why didn't you feel it? I don't know. I just didn't feel it anymore. We just nothing changed. I just don't feel it. I got to tell you, 90% of the time it goes up like 10-15%. And I was like, wow, that was dumb. And then it just detonates. And I can't explain to you why I have this gut feel. I just have a gut feel. And having traded with my gut and, at first trading against my gut and now trading with my gut, when my gut says no, I just get the hell out of the way. And it's a weird process because if you go to an institutional allocator and it's just like, yeah, I woke up with a nasty hangover and we liquidated the portfolio, it makes no sense to people. But the history says that's the right move.
Well,
I don't trade.
If you think about it, George Soros used to sell stuff when his back hurt.
Yeah. I mean, it makes no sense. I mean, there'll be days where I just can't fall asleep. And like, why can't I sleep? And I start thinking about my portfolio, and I'm just like, you never know which is the stock that's keeping you up. But you can kind of zero in on it pretty fast. And the next day you sell some, and you sleep just fine. And you sell something else, and you can't fall asleep. It's like that wasn't the one. I can't explain it.
Well, I would argue that your brain is actually doing that, processing it all behind the scenes. And even though you can't put it into words, I think you're like, I've seen this before. Like, I think your brain is making the connections and looking through it all and is doing it for you. It's almost like AI for your brain. You just don't realize it's occurring. No, honestly, I honestly believe that.
I mean, look, I've done this for 2 decades, and I know that when I bet against my gut, I always lose. So I just roll with the gut. But, I think you get a repeatable process like that only by, staying silent and listening to your gut and listening to what's around you and not second guessing stuff. And, it's a repeatable process. And I want to stress that this is repeatable, and it sounds like it's not repeatable. It sounds totally seat of the pants. But, finding good trends, like they all look the same. They're all some sector that's starved of capital where something's changing and suddenly there's going to be pricing power, and then suddenly there's going to be return on capital, and things are going to get better. And, the over-levered companies a year from now will start paying off the debt and they'll get a better multiple. Like, I've seen this story so many times, and it's always so obvious. And someone will pitch me some idea, and I'll be just within 5 seconds, viscerally, like, there's no way I'll own that. Or someone will pitch me something and just viscerally, like one of my analysts pitched me something on Monday, and I'm just like, man, we got to own 4.9% of this company. Like, within 30 seconds, I'm like, you're totally right. Like, I know the company. I haven't looked at it in a couple of years, but you're totally right. I see exactly what you're seeing. Let's start buying. And, now we're doing the work on it, but I already know we're going to buy 4.9% of it. It's almost why are we doing the work, And I don't know, it's pattern recognition. And then on the exit, it's also just gut feel rather than pattern recognition. But anyway, no one's really asked me about that. And I still can't quantify why I do half the shit I do.
Back to your old timers about the feeling that they want to talk about their feelings or whatever, which I think is hilarious. A Cuppy turns 40 and all of a sudden he wants to talk about his feelings. There's a good.
Well,
sorry, go ahead.
No, Kevin, it's different.
It's different. It's always
I put some money away, and I don't want to lose it all. It's different.
That's true. Well, you know what? Wait till you turn 50 and we'll talk about fiber and other things like that. One of the things that someone said that I think is really wise, they always said everyone thinks the battle is against the markets when they don't realize the battle is against themselves. And
that's so true. That's so true. And look, there were all these books written about, psychology of markets and psychology of yourself. And I always just ignored those, and the older I get, I don't want to say that I dive deep into those books, but you can't trade against yourself. I have a really good friend of mine, and I'm sure he's listening to this. He's going to probably call me up and laugh at me, but he'll call me up about once every 2 weeks or so. He's an investor in my fund too, and I've known him for 15 years. He's like, Cuppy, how's your head? How are you feeling about this? How are you thinking this? He asks me 5-10 questions, and I don't know how he does it. But we talked for about 10 minutes. He's like, Cuppy, you're good to trade. Go size it up. And there's times he's like, Cuppy, like you're lost in space. Like, just go on vacation. And I'm like, what did I say, man? He's like, I can't tell you. Just go go to cash and go on vacation. And I used to be like, fuck you, man. I'm going to trade and just make $1 million tomorrow and just prove you wrong. I just fuck something up, And now when he's like, Cuppy, like you need to go on vacation. It's like, yep. I call my wife up, and I'm like, I tell her, like, spin the globe, tell me where we're going. We're going to the airport right now, and we're going to buy flights there. Like, am I bringing warm clothes or cold clothes? Like, we're going.
That's awesome. All right. So, Cuppy, it's been a real pleasure having you on the show.
Oh, yeah, for sure.
Let's get over the housekeeping stuff out of the way. Why don't you tell people where they can find more about you, your great product, Kedem, where you outline macro trades that you don't do that are huge winners.
So go to Kedem, KEDM.com, take a free trial. I don't think you'll ever trade the same way again. If you want to learn more about me, go to Adventures in Capitalism. That's my blog. I cover a lot of the things I'm doing and thinking about. And yeah, if you want to learn more about my hedge fund, go to Pracap.com.
So I just want to take a moment. Actually, I'll let Patrick go first. You can say thank you to Cuppy, and then I'll finish.
Thanks, Cup, man. It was great to have you on, man. I'm looking forward to seeing you. We'll find a time to hook up next year. I'll come down to your island.
Yeah, you guys need to come down here. We need to tape one of these. You guys see my new office. I got to get you guys down here somehow.
For sure. We're going to do it. We're going to have the market huddle in Puerto Rico. It'll be awesome. But I just want to take a moment to say thank you, Cuppy, for being just a wonderful guest, a great trader, and a terrific friend. It's been just a pleasure getting to know you, and I just want to thank you for everything.
Oh, that's so kind. And, thank you guys for setting up the huddle. Like, you guys have had so many guests on. I've learned so much. I mean, I'm not just a speaker. I'm a listener, too. No, I mean, I've learned so much from some of the guys you've had on. It's, I feel like so many of these podcasts are just about, hey, what's the market doing tomorrow? Or give me 3 stock picks. And you guys ask the deeper questions and, kind of really dive into, process and thinking and, a lot of the macro stuff that people just kind of gloss over because they're not in the trenches. And no, it's just a much better podcast. It's one of the few podcasts I actually listen to, and I don't think I've missed an episode. So, thank you guys as well.
Well, thank you. That's very kind of you
awesome,
to say.
Buddy.
All right. To another 200, Cuppy.
To another 200.
All right, buddy.
All right, cheers,
thanks.
bro.
Take care. All right, Patrick, it's time for talking charts. Let's go through it. Lots to talk about.
Well, yeah, let's just start off with the top 3 things we were watching for the last couple of weeks, and then talk about what we're going to watch for the rest of the month here. And so number 3 was, will the commodity breakout stick? And what was interesting about this one, Kev, it was a mixed bag. We'll get through a lot of them in there because I would argue that gold, silver, copper are still kind of holding in, but some of the big ones like crude oil and many of the grains and other things are just struggling. And so the breakouts arguably I'd call it it didn't stick, even though there's a few one that I think still may work. It wasn't that great of a run this go around.
All right. What was number 2 that we were watching?
Inflation. and that was a doozy. I mean, we finally seen at least a little bit of a pause. That momentum it had to the upside, it kind of reverted. It obviously got the market quite excited. Bonds reversed on that. The stock market took it well. It certainly gave a risk-on impulse, didn't it?
Yes, I would agree with that. But one of the, I think, the disappointing aspects of it, although inflation came in lower than expected and the initial pop was big, and I think it was one of the largest CPI-induced S&P moves that we've seen, it's been kind of disappointing since then. Very little staying power.
Yeah, I want to talk about those charts in a moment. And obviously, number one, we were watching the elections, and obviously it lacked clarity at first. So there was no explosiveness of any reaction of something like when Trump won. There was a big market reaction in the after hours. There was nothing of the sort. It took weeks to really have clarity as to how all the elections came in. But I mean, overall, I was under the impression that generally the market would take it bullish if there was a mixed government, and with the House flipping, I think the market got that. It'll be interesting to see whether the bulls build on something like that. Did you think there's something more to it, or is it just a small reaction?
I don't know. All I could think about was, you said I'm under the impression, all I could think about was that great scene from Office Space where the guy says, I was told there was going to be cake. That's how I feel. You know that, Patrick. I'm surprised you got that joke. That's unusual.
That's one of my favorite movies. I don't watch many movies, but that one is, and that's one of my favorite lines. You nailed it. That was perfect. I love it.
All right, what are we watching for next week?
I was under the impression there was going to be cake. That's for sure. So for the next couple weeks, I mean, it's no longer a 1 week thing, but not next week, but at the end of the month, we have OPEC meetings, and with crude oil struggling here. It'll be really interesting to see what comes out of that.
Yeah, and it'll be also interesting to see if Biden gets back his oil that he sold out of the SPR. Won't it be hilarious if he actually ends up making money on this trade? I know it just infuriates everyone to even think about that, but it just makes me laugh. Like I'm almost rooting for him just to see how many people will be pissed off on Twitter.
Yeah, but it's also very counterintuitive because market participants tend to have an edge on the government, and the government's usually
it'll be the first time the government ever does a trade that works. Well, think about it. Like gold, when George, whatever that guy's name is from the UK, Brown, I believe is his last name. He sold gold into the hole. Like there's been all usually
the government made money off of TARP. Right,
that's true.
Like
You're right.
They bought up all the banks.
People don't like to talk about that, but you're absolutely correct that they did make a lot of money there.
So is this going to be a part
the next
two
TARP? And no one will talk about it because we won't want to have them.
It's going to be shame anyway. Yeah. So we'll talk. We'll talk the oil chart in a moment. There's also the Fed meeting minutes. Certainly, it'll be interesting if we get any change in terms of expectations of what's going to happen in terms of the December potential next rate hike. But do you think they're just
one second? I actually think this is a great one to put in the top three, and the reason I think this is because there are a lot of shrewd front-end stir traders and bond traders that believe that the Fed I don't want to use the word pivot because pivot implies almost that you go from one way to another way. Shifted in their stance in the recent Fed meeting. And yet we see Powell talking hawkish, and then we have the Bullard who's always kind of a knob and will say stupid stuff. And it seems to be that a lot of equity folks that are bearish, especially the bearish folks, they want to see a Federal Reserve that's hawkish. They believe that that Powell's still on a warpath to kill the economy. That everything is he's determined to make unemployment 5% again, yada yada yada. And the thing about it is that I suspect there is a chance that in these minutes we see that the committee is not in line with what Powell is saying publicly. So I think it's a great thing to watch.
You know what? the one thing that I kind of would love your opinion on, right? So, okay, here's a chart of the Fed funds rate going back the last 20 years, right? And there's obviously the last prior 3 rate hike cycles. But whether you take the 2017 go or the 2004 through 2006 rate hike cycle, there were these after the rate hike cycle, let's say that ended in the 2006 window, it went for almost, what is this, almost a year, where they just kept rates unchanged, and it ultimately still led to a crisis. But what is there a possibility in your mind that everyone's working on this like pivot or this change by then, but they might just stop raising rates, but it may not change the inevitable thing that a recession will still come, they still break something, and
Patrick, I completely agree. I think that everyone's accepted that aspect of it. The question everyone's wondering is, does he raise rates so fast because of he's panicking on the inflation that he causes either a market event or an economic event that forces them to actually have to be retreating and lowering rates at the end of next year? And I would say that if he slows down now, he has a better chance at not having to lower rates later. And that was really what we were on, this kind of, the market felt the more he panicked by raising rates quickly now, the more likely he would have to panic on the other side and lower rates later when he causes the inevitable crash or recession that ends up being harder. It's in essence, his chance of achieving a soft landing or even like any landing is diminished by the more aggressive he is, the less chance that he's going to be able to sit there at unchanged and go for a year like that, right? And not only that, the faster that you go, if you go at 50 if you go at 75 bips a clip, there's a greater chance that you overshoot it, because let's remember, monetary policy acts with long and variable lags. So if you're sitting there and you're trying to tune an economy and your policy decision doesn't really get felt for 6 months, and yet you're going and raising by 75s at a clip, there's a good chance that by the time you figure out you've gone too far, you could be 150 too high. And I think that's, in essence, what the market is telling you. But it will be interesting to see if that is the case. And if it's not, and we do get a situation like 2006, where we get a situation where they just, let's just imagine that they go 50 this next one, 25 the next one, and then they just pause, which is what a lot of smart folks, for example, Morris, I believe Morris Sachs, our buddy, who knows a little thing about the bonds, he's learned a few things along the way. This is what he thinks. So let's imagine that happens. What occurs if we do pause and the economy doesn't fall back, and all of a sudden we get a situation where the yield curve goes the other way, and instead of flattening, we get the long end selling off because it's a regular positively shaped
bear steepener.
Yeah, and I think that's interesting, and I think that there's more of a chance of that occurring if they pause or slow down at the very least their hikes now. Anyways,
I listen. Anything is possible, and that's an interesting theory. I still. You have to use the base case of what is historically the precedent, which is the Fed doesn't stop till they break something.
But that's not quite true. Go back to your chart. They go sideways for a while on a lot of times.
Yeah, but I mean, ultimately, a crisis is what always starts some rate cut cycle. No,
right? Well, you're
more
right.
often than not.
So the rate cut, they cut when the shit's hitting the fan. You're absolutely correct. Yeah. And so the question is, have we made ourselves more likely to have the shit hitting the fan because of the speed upon which we've raised rates? Time will tell. It's going to be difficult to decide.
So number one, the jobs numbers, and which are coming out not next week, but the week after, right? As we go in the first few days of December. And the interesting part of it is, I mean, you keep hearing these tech companies laying off tens of thousands of employees. And it just seems like this number has been so resilient. And it's like, when do we finally see the jobs numbers crack?
Doesn't it seem like it's almost wrong? Like, how is this the case?
How is it possible?
Yeah, I don't know. I'm sure people a lot smarter than you or I, which isn't very hard, would probably be able to answer that question. But it feels to me like it's one of these things that we're gonna look back and they're gonna readjust the numbers and they're gonna say, oh, actually there were a lot of people unemployed and all those numbers were wrong. And I go back to always the famous thing about Bill Clinton beat George Bush Sr. For the presidency, and it was he kept hammering on about like it's the economy stupid, and everyone was saying we're in a recession. And I think that in hindsight, when they go back and you look at the numbers that were adjusted after the fact, meaning like a year later, they figured out they actually counted up the economy, like how it had behaved. We were already coming out of the recession under George Bush. Yeah. And it had nothing to do with Clinton. It was just timing. And unfortunately for George Bush, it was all these numbers were coming out showing how bad the economy was, and it wasn't until later that they were revised much better. And I wonder if this is going to be one of those cases.
Well, there you go. So let's talk some charts, buddy.
Okay, let's do it.
So S&P 500. First of all, this entire rally that we have seen off of the low has now to that little peak level, just above 4,000, was just over a 30-day rally that was about 550 points. And the interesting part is obviously we were ridiculously oversold back in September, October. The sentiment was incredibly negative. When a market is that way, it's either going to outright crash, the way, Cuppy thinks, let's say, Tesla may break. Either the market just has a liquidity event and wipes, or inevitably it's going to mean revert and correct the other way. And so we got this correction back to 4,000. But this is actually, I think, a very important moment in the market because obviously I don't know if you can. There seems to be so much going wrong. Obviously, crypto money is not driving stock markets, but it does influence sentiment. And I wonder whether or not this is an environment where the buying momentum can return in any meaningful way. I mean, while I still think the market can have a couple stabs on the upside, maybe 41, 4,200 going into December. One of the things I'm going to be watching is whether this gets very toppy and starts to roll over and give signs that the new year might have another breakdown. Am I being too bearish?
Well, you're always too bearish, but that's okay.
Well, okay. Well, what's your bull scenario? How do you think this plays? You think what's your upside? Like 44, 4,500, or you're like thinking we go new highs?
No, not a chance. I don't think we get to new highs. So tell me what. Go from the high to the low, and then tell me how much of that retracement we've done so far.
From the very big high.
Yeah, like the high of last summer.
Okay, so we had a 1,300 point S&P point drop.
Don't you have some sort of like Fibonacci thing?
Yeah, I can. But let me just kind of do it this way. It's 1,300 points drop, or 27%, and we have so far right now retraced 500 of 1,300 points, 550 points of 30. So, okay. A 50% retracement would be, let's say, 750 points. That's 4,300.
Okay, so to me, that's kind of the number that at that point I'm more neutral.
Okay, so that's not much different. I don't see us having a problem hitting 4,200. So I'm not immediately. So then wait,
bearish. What's 5/8? What's 5/8 of that retrenchment?
5/8?
Yeah.
Well, I mean, okay, so then you're talking about like a 61% retrace. So that's 4,400 or something. Like, yeah, you're talking.
That's what I think we're gonna do.
Okay, but that's not exactly bullish, dude.
Well, like, it's not bearish. Why would I? No, if I think the next 500 points is up, why would I be short?
No, okay, but do you, how long do you think a rally could last? Do you think we're talking like a 3+ month kind of advance here?
Well, I think it grinds higher into the spring.
Really?
Yeah, I think
I'm much shorter in my bullish time frame. I think the next 30 days could see markets grind higher. So I have a half as bullish scenario as you. I think it's in about half the time, in about half the distance that you're thinking, the market could go up. And I think that as early as the new year, we could already have a market that's rolling over. But you know what? That's just a theory. I'm obviously going to technically stress test that. I mean, I'd have to start seeing the price action showing some kind of bearish signs because there isn't any right now. The price action keeps getting bought on dip, the price and generally working higher. I see absolutely no reason to be short right now.
Okay, so I find that interesting because a lot of the bears will tell me this action's terrible and that the market is behaving badly. You feel differently?
Yeah. Well, okay. I mean, okay. It depends on your time frame, because I'm just like looking at the way the last couple of weeks. Like, I mean, every single one of these little dips in November, almost immediately the buyers come in and take it to a higher high. Like that's not bearish. I mean, fine. We haven't broken August highs and other things like on weekly charts where the long term trend followers are going to want to see big trend lines broken and the bigger pattern shift. Sure. I mean, I guess it's all about what kind of a trend that you're trying to identify. But look, we put in a tradable low in October, and the market is 500 points higher, and it's been working its way higher in a relatively step-by-step bullish price action. Okay. And that has not turned bearish yet. And as soon as we start seeing that price action, like failed rallies, sell-offs doing some real damage, and bulls can't recover it, and you see that things get very heavy and toppy, then I'm going to start getting nervous. But that's not yet.
Yeah.
We haven't.
So
seen
that's what I like
yet.
about you, Patrick. You'll listen to the chart, you'll get bullish, but only for a month or two. And
listen,
then that's it. Then fundamentals are going to kick in, and we're going to go a lot lower, and bonds will be 1% again.
All right, we can get to that in a moment. Well, listen. If this is an interesting debate, though. Let's actually have this for a moment, because how do you square this idea? Okay, so I subscribe to this view that we could continue to have commodity and food-driven kind of inflation pressures, but I also believe that could be paired with asset price deflation. Where just prices in the markets and in real estate and everything could continue to be under pressure, right? But the thing is that how do you square a world where the cost of living is rising and maybe the CPI continues to show positive prints, but the value of all net worth of everything is just getting clobbered? I mean, under that environment, can you not see bonds rallying?
So you think commodities are going to rally?
I'm not forecasting that. I'm basically saying if that's the scenario that is emergent, could you see a scenario where bonds rally under that environment?
Oh, well, listen, first of all, I could see bonds rallying. They are so oversold. It has been a disastrous, ugly bear market. So are we due for a bounce? Yes.
Well, we are.
I don't know. Yeah, but we could be due for a bounce that takes us a long way, like a long way.
Well, I mean, look, the long bond was almost 40% murdered from the high. Like, so, I mean, at this stage, when a bond gets killed like that, I mean, if the long bond goes from 125 on the future up to 150, it's still not even halfway undoing the damage that was done through the whole move, right? But I'm just saying, though, scenario.
We're never going, by the way, to those rates again. I'm not going to be like, who was the idiot who said oil will never trade above here in my lifetime? Was it Dennis Gartman?
Gartman said it was Gartman on 60.
So I will never say shit like that because anything could trade anywhere because I'm going to live forever.
But you're about to say it again. You're going to say something stupid. What are you going to say?
But I don't think bonds will trade that.
Okay, we're talking long bond here.
Yeah, right? That low in yield for a long time to come.
So what's that low? Because I think we could be under 3% on the long bond.
Okay, but like, what are we now? What is the yield right now?
Where it's 3.92. But so a move to 150 on the long bond on the future is going to be rates going down to 3% or so. Like we're not talking about about, like to go back to 2% on the long bond, that's where we're talking about retracing the 2022 carnage in its entirety.
So do I think the long bond can go to 3? I think it could. I think it would be a mistake and it'd be a great chance to sell again. Because ultimately I believe that rates are in a new secular, bonds are in a new secular bear market. So, but we are so oversold, Patrick, we could easily get that. Like easily, like it could happen in our.
But I guess the bigger technical question then is: has it started? Like the thing is there the underpinning conditions for there to be one more leg lower in the long bonds in this window of time? Because I hear you. Like if we're going 2 years out, of course they can be lower. The question is that let's say over a 3-month time frame, do you think the long bond can get slammed to a lower low?
So ultimately, I am such a bear that I am hesitant to go and say that it can't happen, because one of the mistakes that I've made throughout my life is to have a kind of secular view on something and then start getting cute the other way. So I'm not going to say it couldn't happen, and especially since I'm so bearish over the long run, yeah, I think it could happen. Do I think that this is a good time to be pushing those bets on the short side? No.
Yeah.
No, I don't think that it's good. And in fact, there's parts of the curve that I'm along. It's not the 30s, but there's parts of the curve that I'm along.
So then let's segue the conversation. Okay, so first of all, I want to go back to that. So is there something in your mind that you could visualize a scenario where things like the commodity markets continue to go higher, stressing the economy, and asset price deflation is dominant? Like, am I just an idiot?
So you're saying commodities go higher and stocks and bonds keep going lower?
Yeah.
Well, that would occur, I think, if we had a situation where Powell felt like he had to offset the commodity rally. So I think that could happen for sure.
Okay.
But I think if that happens, Patrick, the thing about it is the part of the curve that you want to be short is not the long end. Because as that occurs, as oil rallies, Powell gets more hawkish, the Federal Reserve raises rates, the curve gets more inverted. So it's actually twos that you want to be short if you believe that Powell will be extremely hawkish to offset an oil thing. So let's just imagine tomorrow oil takes off. Oil takes off, and let's say it's 120, and Powell says, geez, you know what? We thought we were going to go 50 and 25 and then maybe pause. But now all of a sudden, look at this. We got all sorts of inflation. We're doing 75s again. We're going 75 a clip until this gets fixed. And in that environment, stocks and bonds go down. And I would almost say, Venture, I hate to say this, but if that occurred, you would often, I would be more amenable to owning the long end of the bond market, because it's basically what they're saying there is the Powell's saying, I'm not going to put up with inflation, and I'm going to go and I'm going to push back against it, and I'm going to push us into a recession because of it. Yeah. I think it's bullshit. I don't think he does it. I think it was easy to be extremely hawkish on the first part, but I think that the federal government has 110% debt to GDP ratio. Now all of a sudden their interest payments are huge. Even the central bank, even the Federal Reserve itself, it used to be they would send money to the federal government, and now all of a sudden they're going to actually be losing money because of the rates. It was easy to be hawkish, 6 months ago. It's become harder to be hawkish. Yeah. And it'll be more difficult, and I don't think he's got the guts to do it.
So here's my thought. The one thing that I'm trying to kind of piece together on the bigger macro. So the U.S. dollar was stupidly overbought, even to the point that I was flattening almost everything.
Yeah, you were good. You called that well. By the way, can I just sorry to interrupt? I was long some euro, and it was mainly because of our discussions here and you doing your technical analysis voodoo. You were sitting there and you're saying, everyone's talking all bearish on the euro. Yeah, look at this thing. It's not going down. Yeah. And in fact, it's going up. And when you started saying that, I put 2 and 2 together. I was like, you know what? Actually, time to buy a little bit. Didn't buy a lot.
Yeah, no, I clipped it as well. But you know what? My problem is that Like Cuppy was ribbing me for all the kind of squiggle in and out stuff, but I don't. I like to pride myself on being actually a bit of a trend follower. So, and the one thing that I kind of look at this is, I don't know whether I'm ready to say that the U.S. dollar bull market is over. And it was so overdue for a pullback. But the fact that we shaved 10 handles off of the Dixie in 2 months, I'm starting to ask the question is how much more downside is there on the Dixie on the short term? Inevitably, look, when the next bull phase starts and the next goes, and for sure the Dixie can go back under 100 and we could have a big US dollar bear cycle. But the bigger question, has it already begun? And I don't know. Like, I mean, if we have a very difficult 2023, and, I think it was JP Morgan that just came out and said their base case is a recession next year. And we have all of these different issues. And let's say 2023 is more challenging than your bull scenario. And under that scenario, I'm thinking the dollar could still have another rip to new highs.
Hey, listen. Anything could happen, and I hear you. It's if you look at the Bloomberg Dollar Index, it just bounced off the 200-day moving average. It did cause a lot of damage in a short period of time. It's difficult to sell down here because
I didn't like the trade up at the top because there was no asymmetry in it. But now that we're down here, I just don't. My intuition is that okay, fine. Is there a risk down to the 104 level on the Dixie? Yes. Do I think that the risk is down to 100? I mean, I call that an outlier. I don't think the dollar goes that low. Not in this environment. And from that perspective, if it turns around and rips, we might have a go at 120. I think actually, I'm
You've been drinking too many milkshakes, young man. Okay, well, you know what? We might have a bet on. I think I lost this week, so you might have something you can.
No, because I'm not. No, because I don't think that this is something that even starts to work in the next couple of weeks.
Oh, okay.
I don't. I'm not. Even
You're gonna savor your milkshake, and you think it's a long, big.
I just think that the 10 handles off the top in this quickly has already most of the dollar short and the long on these other cross currencies. The easy money's been made. There's room for it to go. I just don't see that you're going to make a similar style gain moving forward from here.
I don't know if anyone would have called that easy money because it was pretty painful being short U.S. dollars.
No, well, it depends on when you started your U.S. dollar short, right? Like,
yeah.
Let's talk commodities. And man, did crude oil have a bad week. I know Cuppy was talking about the sting a little bit, and we didn't get into detail. But over the entire month of October, the price action, kept looking like it was being accumulated towards the elections. It looked bullish, working its way up. It even prairie dogged the $90 level like it was ready to go, and then post-election just ate it. Like $10 on the downside just over a week. And more importantly, has not even legitimately demonstrated any legitimate shift of trend, and it's disappointing on the short term for the bulls. And really, the question now, with this kind of technical damage, will all of the third quarter lows, as we approach down here, hold the line? I totally get the bigger picture bull case for oil. But it's hard to say that there's something that's starting now. Like this could stay in the gutter for the rest of the year.
Oh, you're really bearish.
No, I'm not bearish. I don't know if it's going to go lower. I just don't. It just doesn't.
It's trading like shit.
It's trading like shit, and
the way, some people are actually taking our technical formation of that chart looks like shit is actually becoming a thing.
Well, I don't think, to be honest, I don't think it's original to us.
No, it's like not original to us. The turtle head and the prairie dog are.
Yeah, but a chart looking like shit. It's like me telling you I invented cucumber water. It's like
you did?
Yeah, I did.
Oh, I didn't know that.
Absolutely.
I don't really like it though. It's not very
Doesn't
good.
matter. I invented it. Anyway, it's but the point is that even okay. So on this chart, in order for now crude oil to start to even technically become bullish, okay. So a lot of basic technicians will use something like short-term moving averages, look at 10 and a 20 period moving average, right? I'll just throw these on. In order for crude oil to have a period where it's on a sustained basis trading, let's say above the moving averages, let's say like it did back at the start of the year, it would at this moment need a $10 rally and a consolidation above those moving averages to just start to turn those moving averages up to begin a trend move. The point I'm getting at is it would literally take a month of price action now to start to technically build trend in a bullish way on crude. And with us only 6 weeks away from year end, it literally at this moment will be a 2023 rally for oil, even if the low is seen in 2022.
You want to know something interesting, Patrick? One of the things that I've been doing recently is following Andrew Beer, who we've had on the show. Mm-hmm. He has a big ETF that, in essence, reverse engineers the positions held by the CTA hedge fund index. And his ETF is DBMF, Donald, Bob, Mary, Frank. And it's a great thing because he actually posts the positions. So you get a sense of where everyone was. And for the longest time, it seemed to be that the index was a lot of these traders, because it represents what the CTA positionings out there in the community were short S&P, short bonds, short front ends, short gold, short commodities, long oil, and long the US dollar. And then recently, my buddy Rippert actually highlighted the fact that there is a way to track this on Twitter. For those who are interested, it's actually DBMF Watch, Donald, Bob, Mary, Frank Watch. Okay, and that's a Twitter handle. And whoever this person is, he created this thing where he shows the changes in the positions day to day. Terrific idea, really smart, valuable service. And what's interesting about this, Patrick, is that oil has flipped from the CTAs being long to short. And I thought that was interesting. It's kind of green with what you're saying in terms of
it's below, like, okay, one of the easiest things to just know, like, I know CTAs use much more complex methodologies, but there's a sense of simplicity in knowing that generally, you could throw something like a 50-day and a 200-day moving average on there, and generally the CTAs aren't flipped long until the price action is legitimately trending above those moving averages. And, obviously each CTA will be getting at different times for different reasons with different, quant ways of sizing up when they're making the shift. But ultimately they're following trend.
Right.
Right.
And it's actually not as complicated as everyone thinks.
Exactly. And so, like, it's not hard to see that, like, when you put a 50 and a 200-day moving average, crude oil has been struggling to sustain any period above the moving averages. And so that's why CTAs are more or less positioned this way.
I didn't understand why they were so long before, but regardless, they're now short.
Do
you think it just chops around? Do you think they just get chopped around, or do you think we're getting a move to 65?
It's entirely possible, but I wouldn't be betting on it. I'm not short oil, and I would consider it a gift to buy it down there if the market got there. I luckily had almost all of my oil positions with a long gamma, and so that even though I took some hits here, I'm not a bag holder if this thing does go down to 65. And I would look at that as a gift, because the other thing to talk about is, okay, let's just talk about where oil is. Oil is near its September low, and what shocks me is how energy stocks are doing so well.
But they were cheap. They were cheap, Patrick. They were cheap. The market, and don't forget, the energy stocks suffered because of the fact of ESG, and there was a lot of social stigma about owning these things. And
Yes.
as this crisis has occurred with Russia and people are waking up, I'm noticing more and more people on the left that have traditionally been like, oh, terrible oil, big oil, blah, 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 are now saying, well, I guess, buying oil from Texans makes more sense than from Putin.
Okay, so I'll agree with that kind of a view, but I don't think that changes the general correlation that energy stocks typically share with oil. They're
But why? Why couldn't they have a repricing against oil? Because I think that they were too cheap before versus oil. Like oil had gone up, and I felt like the stocks hadn't gone up. And now they're increasingly getting re-rated to a proper price depending on oil. Like I could see, Patrick, oil going nowhere and these energy prices continuing to rally. Like we have like 3-6 months of oil just sitting here.
How can we do this? Because that might be a bet. Is it XLE to the USO? Should we do? How would something like that?
I don't know. Right? It's too long. I feel like that's too long dated. But to me, I could for sure see that happening.
Huh. I personally look. I am bullish energy. We've had a bunch of energy stocks on for the longest time. It's done very well for us. Like a bunch of our breakout trades were a whole long a bunch of these energy plays. So I'm not in any way energy bearish, but I personally think these energy stocks are due for a step back. And the fact that oil is breaking this way, the bigger question: are we finally going to see these things pause? And I honestly think a lot of the money flow. Now, listen, you've been on this for years, not years, maybe most of this year when this whole energy movement's going. You've talked at Cheap Energy. You've been on this. Kudos to you, buddy. You've been making good calls on this, but. The bigger thought in my thing is this is now a flow where if you look at what sectors have performed this year, there's only one sector that is grossly green on the year, while everything else is either flat or red.
In what manner are you using grossly? Because I think oil energy bulls would say it's definitely better be the gross is in the number.
Yes, I'm just trying to differentiate.
No, I understand what you're saying. It's like it's the only thing that's worked. Let's face it.
And the thing is that in my mind, now we're getting to the stage where people like fund managers just need to own energy because they just don't want to look stupid to their investors that they missed the energy train.
Okay, right? Does that mean that we rally into the year end and like it tops like a week before? And that might be a good thing to study. Like, what happens to the winning sectors going into a year end? Do you find that the outperformance increases or does it decrease?
Look over here on the FinViz on a 1-year performance.
Yeah, like you're just showing me this because of the bald ad on the right.
Yeah,
I am not using whatever Portuguese hair product that is. It's not happening, Patrick.
Anyway, you could probably use it though, buddy. All right, so
there's a point where you got to just give up. I hit that point a long time ago.
But the point is that energy is up 42% on a year basis. The next best performing sector is utilities, up 1%, and every other sector is red. And
you better have got that call right, because if you didn't, you really performed shit, eh? If you didn't own the energy and you were long tech, let's just go back. Can you go back for a second?
Oh, I just shut it down.
Shitty. But what was tech down 35?
Yeah. So those people overweight the fangs and out of energy ate it, and those people that were long energy, like you and Cuppy, and actually I was too, but so the thing is, when you're long energy, it saved your portfolio.
Yeah. I would say that's kind of like the two guys from Dumb and Dumber when they say, "How's your burger?" That's what we should say to the people that were long. They were long tech and short energy or underweight energy. How's your burger? What are their names? I was trying to. Unfortunately, you went too fast, and I couldn't get their names. What were the names of the two characters in there?
Oh my God! Now you're putting my
Let me just look here. Plot.
Lloyd. Was it
Oh,
Lloyd?
you're good. You're
Lloyd
good. And you know what his last name is? He's very good. Lena, can you hop on for a second? Do you know this?
Oh, don't put me on the spot.
Oh, come on, you got to. So Lloyd is right. So Patrick comes up big. Now he's named after a holiday. His last name.
Christmas.
Yep.
Lloyd Christmas. That's right.
And then Harry Dune.
Oh.
That's fine. That's awesome.
Anyway,
Okay.
how's your burger?
How's
Anyway.
your burger? That's what we should ask everyone that had that trade on. How's your burger? It's a shame we got a name for the show already because that would be a good one. How's your burger? Okay, keep going. I'm sorry. Lena,
Anyway.
go back to sleep. See you later.
So let's just move on for a moment. But anyway, I still think that energy stocks take a hiccup, but it is going to likely. It's going to be something that people want to keep on the sheets till the year end because they're going to want to show it on their holdings. Right?
All right. Well, maybe it's an opportunity then. If you get a situation where oil
It
shits the
dips,
bed
you buy
and
it.
goes down, let's just say it does go down to 65, you should be selling
And
your
it's
energy stocks into the fact that everyone keeps owning them and buy the actual underline. Might be a trade there. Okay, what do you got?
No, but I actually think that at the same time, if the energy stocks give you, let's say the XLE dips down to 85 because oil's taking a slam below 70 temporarily, then you buy the dip on the energy stocks
so you're
for a
just,
year
you're just
rip to
nervous
100.
about oil in essence, and you're saying that there's a.
I'm just
no-
saying, like,
no-
the
no
fact
point-
that energy stocks are still at their 52-week highs while oil's shit in the bed is, at some point, is the correlation going to matter?
At some point, it will. If I think that if this was the low and oil just grinds around nowhere, energy stocks will be fine. That's my call. If we go down another $10 from here, yes, probably the stocks,
Yeah.
the energy stocks get hit. At which point you're saying you're going to buy them. In fact, if that happens, maybe it'd be better trade to even sell your energy stocks and buy the commodity. But who knows?
Yeah.
All right, what do we got? Gold.
Yeah, I just wanted to talk precious metals. So gold and silver, they ripped literally like the euro. These continue to almost behave like a cross currency to the U.S. dollar. The big question for me here, are they going to be bought on dip here? They're now going to do the typical 50% retrace. Maybe gold gets down to 17 and a quarter here, but will the buy on dip traders come in and demonstrate that we're in some sort of new accumulation cycle for a year-end gold rally? Or is this just going to be like every other gold rally this year and we're going to find ourselves at 1650 within 3 weeks?
I will say this. When you start talking about like that, it reminds me of the emperor when he says that let the hate flow through you. I like your despondence. I hope you keep that up. I want to see you, Don Cox, this thing where those who know it best love it least because they've been burned the worst.
What do you mean? I'm long gold.
That's not what I want to hear.
I'm not
It's
out.
not going to work. Although this might have been the time when we're both long. Although, to be fair, I think I owned way more silver, and the gold was almost like a tiny little spot thing. Did you own silver?
Yeah, I did.
Oh, so I don't understand what happened. There's something. There's a
Something's
rip, There's a
wrong.
rip
We're
in the
both-
universe or something.
Yeah. How could we both be right at the
Yeah,
same time?
you know what? Maybe
This
it's because we didn't talk about it.
No, we didn't goocher it.
That's right.
Kept,
Yeah, okay. All right. So as long as we don't talk about it, we're good. So don't talk about silver.
Okay, next, moving on. All right, I'm not going to talk about copper then either. Let's just move on.
You can talk about it. You should talk about it. If you have a view, and you should share it with us. You had a great call. You were early there, and you did it. Now it has backed up. It had a past couple of weeks.
It's at the 50% retracement. This is this 360 area is got to be a really interesting moment because if this was a legit bull breakout and copper is heading, let's say, to 4+, maybe 4.25 or something, it should be bought on dip pretty soon next week. It would be a technical disappointment if it gave back the entire breakout.
That's what my parents called me.
Disappointment?
A technical disappointment. Fuck, that's another great name.
Not
for
just a
this show.
disappointment.
A
Not a disappointment, but you were a technical disappointment because there's different forms of disappointment, but you were the technical variety.
Okay.
All right, listen, I can't do any more charting charts. This is good enough. We'll leave it at this.
Okay, great. All right, let's time for no stupid questions. No, time for skin in the game. I'm trying to forget it because I lost.
I gotcha.
Yeah, you did. So tell people the bet that we did.
Well, I just, this one guy I know made this ridiculous call that financials are going to outperform in this environment.
He's an idiot. That guy doesn't know what the hell he's talking about.
And even though, like a broken clock is right twice a day, the thing goes ripping higher after he writes about it. Maybe it's like a Warren Buffett effect. I guess someone reads his newsletter or something. And ultimately...
You think I'm moving the XLF? That's even funnier.
I was trying to be funny. Okay. No one believes that. Okay, so but
what did anyone reads my letter?
that's funny too.
All right. So what was the bet?
You use too many big words. You should put more of those funny pictures.
That's right.
I'd read more of it.
Okay. So we bet. I guess what was it? The XLF over Spider ratio, and I got S&P. Crushed.
No. It just stopped going up.
Okay.
It just stopped going up, and I got lucky that it.
Okay.
It closed below.
And do we actually know what we bet this time? Did someone write it down?
Yeah, it was. Lena was saying it was 2 points, right, Lena? So you didn't allow me.
Oh, yeah, I knew.
Kevin
was
very adamant that you only wanted to bet 2 points.
Oh, that's good. That's good. I obviously am not a complete idiot. Just half an idiot. 2 points.
You just so that you can keep the lead.
Oh, that was it. I was just so petty.
No, you were like, I'm not going to let you take the lead on this call.
Small man, big truck. That's what I'm like. Small man, big truck. Okay, listen, let me tell people about Skin in the Game. It is our weekly opportunity for us to demonstrate that we are degenerate gamblers at heart. Every week, one of us presents a wager, and the other guy chooses which side of the bet he wants. Every wager needs to settle by the next episode. And the rules of the game are we're going to play up to 50. And then the loser of the match will take out 3 lucky or unlucky, depending how you think about things, Market Huddle listeners for a dinner where they grill him about why he had so many bad calls. Patrick, the score right now is 22 for Patrick, 23 for me. As they mentioned, I'm still in the lead. You got to bet to try to get in the lead for next couple of weeks. What do you got?
You know what? I got a kind of vibe from you when I was talking the dollar, and so let's just keep it clean on the Dixie. Higher or lower?
Come on, that's not fair because the thing is, it's due for a bounce. You got to give me a little bit.
I'm giving you a little bit. You pick up or down. You have the choice.
Well, I respect you not giving me any. Okay, I'm going to choose down because we got 2 weeks. If it had been 1 week, I would have chose up, but we got 2 weeks, so I'm going down.
You're going down.
I'm going down.
Okay,
maybe in more ways than one.
So we're going to use is it fair we just use a clean 107? It's like it's 107 spot 004.
Okay, 107. That's fine. You can chisel me as usual for that 0.4 of a point.
Just make it nice and clean.
Okay, 107.
It's either over or under 107.
Why don't you like make it a nice clean 107.07 or something? But anyways, that's fine. 107 even.
That's because that ain't clean.
Okay.
All right. Okay. So the question is,
how many points?
Now you blurt shit out. I want the lead. I'm gonna go. You know what? Because I want 3 points. I'm gonna say 4 points. So that way, I would take a 3-point lead over you if I.
2 weeks from now. So we have unemployment that day, right?
Oh yeah. So the jobs number is going to be a big driver.
Yeah, because it's going to be.
You could be offside the entire time, and then the jobs number will throw it right.
Or
I
could be onside the entire time and then lose in the last little bit. Okay, I'm going to go for 4 points. I'll take your 4 points. I'm not. What the hell? Let's do it.
All right.
4 points.
It's appropriate that the jobs number will decide it. That's hilarious.
Maybe I'll be so onside it won't matter. Maybe you'll be so onside it won't matter. Maybe you'll be so onside, and then that'll just be the nail in the coffin, and it won't even be close. It'll be trading 111 and then go up to 115, and your 120 milkshake will be in play. All right, let's go on. We got the bet.
No stupid questions.
No stupid questions, Lena.
This is where Lena comes and saves us.
We have quite a few questions this week for our 200th episode.
All right, okay. Let's do it.
All right, so first one here. What does financial repression do to worker productivity? What is the point of working above what is needed for food and shelter when the government is making it difficult to save? Cheers.
That's a fun question.
Well,
I'm just going to go and get in the bath with some razors. Like what? Like what?
But isn't the whole purpose of financial repression is it to be almost invisible, right? Like only the people that understand things like real yields and shit like this really understand what is happening. 99% of people look only at nominal things.
Yeah. Well, and the other thing I would point back, sorry to interrupt, but the other thing I push back against is that financial repression doesn't necessarily mean that you're working and that you're not gaining against inflation. That's actually not financial repression. It's actually when the government makes it difficult to save, meaning whatever you save gets financially repressed away, meaning it gets inflated.
Yeah,
away.
but let's say you're through financial repression, your savings gets chewed up 3%.
Oh, I see what the fellow's saying. He's saying, what is the point of working above what is needed for food and shelter when whatever you save goes away? Yes, okay, fair enough.
But the thing is, but if you're getting clipped 3%, you're only getting clipped 3% on the real purchasing value. Your nominal rate, you put it into some certified deposit or GIC or something, and you still see a nominal increase in your savings. You just don't know that the value of what you can purchase is worse. And so most people never can tell that they're in a period of financial repression.
Well, and the other thing I would argue is that who is really financial repression hurting? It's not hurting the workers usually the most. It's hurting the savers. And so the question is, yes. So is the worker getting hurt? If you're a young person that has many years ahead of employment, and let's imagine that at the very least, the financial repression is not going to get any worse in terms of your salary will stay below inflation, but it'll stay constantly at the same rate below inflation. That doesn't hurt as much as the saver that's the retiree that's on a fixed or has to own bonds, and they're finding their cost of living increasing way faster than their income is.
Yeah.
And that is really truly what is financial repression. More so, I think it's a transfer of wealth between the generations, and I really do believe that is the designed effect. And now the question is, should you do it so insidiously through this kind of setting of rates, or should you just be more overt and go, tax old people with money? I don't know. And the other point is, who really cares? It's going to happen. So if it's going to happen and it's as old as time, just figure out a way to make it happen.
And it's also relative. It's happening to everyone all at the same time. And so the thing is it's all about where you stand versus your neighbors, right? Like ultimately, it's not like you in isolation are suffering from this.
Well, but not only that, Patrick, if you can accept that it is going to occur, you can take strategies to minimize it and actually maybe even benefit from it. Anyways, just throwing that out there. Let's go to the next question.
Hello, Patrick and Kevin. Big fan here. Greetings from an RG recently moved to Spain. Due to the high volatility in the stock market and the appealing yields in U.S. bonds, I believe it's a good option to park savings there while waiting for the market to lose some volatility without losing liquidity. My stupid question is the following. Since the Fed is likely to keep raising rates for the next couple of meetings, and as investors we are looking for higher yields, is it convenient to wait to buy them if we smell that there is a near end to the hiking process? Or does the market always price in those movements ahead of time? How does future hikes in interest rates affect already issued bills, notes, and bonds? And what about the new issuances? When the hikes are done, those instruments most likely will start going up, or does that depend on the inflation rate? You guys rock. Cheers.
Do you want me to take this, Patrick?
You can, but you know what? I think that this is Pablo. You know what? Pablo nearly came out to one of our huddle meetups. He was messaging me. I just want to do a shout out to him anyway. But yeah, go for it, Anson.
Okay, so they lots of different parts there, but the market is always anticipating and pricing in future policy, and it also prices in future policy on all existing notes and bonds and T-bills. Now, there is times that there are spreads between what's called the on-the-run bond and the off-the-run bond, meaning that if you buy, let's just say, a 2-year note that is the newest one that everyone's trading, it might trade at a slightly lower yield than the one that was last quarter's. I think it's quarters. I can never remember. 2-year yield, 2-year note, because people want the liquidity of the on the run one, but those are very minor kind of inside baseball type differences that actually won't really matter to you. The important part to realize is that all of the instruments have built in what they expect future policy to be. So that's there. Now, within there's government, and then there's corporate credit. And I think that did Pablo mention the U.S. bonds? Well, I think that one of the ideas that a lot of people I've seen recently that they're starting to look at doing is they're saying, why am I going out and buying equities that, are suffering? They're expensive on a PE basis. We have these rates that are up, and when I can go buy corporate bonds. And that is a trade that's becoming increasingly popular, is that people are forgoing buying equity and replacing it with corporate credit. Because with corporate credit, you get not only the government rate, but the spread between corporate and the government rate, which is higher. So meaning that there's a lot of bonds out there that are yielding good 6, 7, 8, 9%. And they're saying, why bother trying to earn 10% in the stock market? Because that could easily become a minus 10%, whereas in the bond market, chances are a lot of these bonds are money good, and it's going to be a much better yield. So that's that. And then if I got everything, well, I guess the only other thing I would say is that when we're thinking about the Fed pausing or not, again, it's all built in there. So what you need to ask yourself is, when the Fed moves, it's not whether the Fed moves in absolute terms, but whether the Fed moves versus what's priced in. So if we had a situation where the Federal Reserve raised rates 25 basis points next meeting, we would actually have a lot of these front-end instruments lift in price, because even though they're raising rates less than what is priced into the market. And that is the important part to realize, that you need to go look and figure out what's priced in and then make your decision about buying or selling based upon that. Now, the other thing is, you could say, I don't care. I'm just going to buy this rate and I'm going to hold it to maturity. It doesn't matter. And that is the case. If you go buy a 2-year bond and it's a 2-year bond of a U.S. government, for example, that is definitely going to pay you on the other side, then no matter what happens, you buy that bond, you are going to earn that yield. So you don't need to sit there and worry about whether the government is going to raise or lower rates by a little bit, because you know that that's a yield that's locked in. Now, having said that, if the Federal Reserve was to come out and let's just say raise rates 75 basis points instead of 50 basis points, which is the 50 that's priced in, then that 2-year note will go down in price, up in yield, and you would have been better off waiting to buy it.
Yeah, I mean, that's when you're trading these the treasury bonds. But what's interesting is that there's a growing number of people out on like the TikToks that are telling people to go and directly buy treasuries and hold them to maturity at these rates. They lock in 4% and these other types of things. But it's funny, but like it's still a negative real yield if inflation doesn't back off.
So
like if you make it.
Yes, you are correct, Patrick, but if you put in what the market is expecting in terms of inflation, it is a positive yield. And if you wanted to, you could go out and buy 2-year tips, and 2-year tips would give you inflation plus, and I don't know what they're yielding now. Let's just say they're yielding 1.5. You would earn inflation plus 1.5. So let's say inflation ended up being 5% and you bought 2 years tips, you would actually earn 6.5%. And the only other thing I would say for retail, especially American retail, I don't know if anyone else can do this. There's Treasury Direct. And Treasury Direct allows you to participate in auctions, I believe, and buy bonds in small lots directly from the government. And I'm not sure of the trade, but there's some trade in there where you can buy an I bond or something like this. There's a trade where you can buy an inflation bond that is actually better than tips and it has a really great yield. And I can't remember it. And I think that ARB is going away as inflation comes down. But I believe that it's still something that people should go look at. If you're American, go to Treasury Direct and then go look at the I bond. I believe that they limit it. You can only own 20,000 or something. But every single bond kind of savant that I know has stuffed like all their kids own it and everyone owns it because I believe it was a great trade there.
All right, let's move on.
Okay, so next question. Hello from Dumb Log Truck Driver, Old
Oh,
Farts.
it's him again.
Kevin and Patrick. Just kidding. Just like busting your balls. An interesting tidbit I noticed in my peer group. Everyone is invested in the market and everyone is losing money. Truck drivers to stay-at-home moms. And everyone says the same thing. The market has to bounce back. My question is, what lotion should the middle and lower class use to repair the butt fucking we are getting?
Oh, God.
Switching my beer to whiskey is doing the trick so far. Cheers.
Oh, my God. I can't believe you guys put this one in. You can tell I was too. Oh, God. Okay. It was a good question. It's pretty funny, but
because there's different lotions that you can put on.
Lotions, okay.
But listen, I think the one thing I just want to comment on this is that this is the problem that retail investors generally have, which is they're typically used to an environment where there's a bull market, which is even dips immediately reverse, and you have a period where trends sustain for long periods. And we're going through a bear market, and bear markets typically are a depressing period because often these stocks can stay down for very long periods of time, and not immediately recover, and some of the companies don't ever recover. You have to almost be in some of the big blue chip names that will ultimately take proper money flow when the bigger trend shifts. And I think the point here is simply that one has to just accept the reality that this bear market may not be over yet, and unfortunately, waiting for this imminent comeback in some of these stocks, just your view, like for instance on FANG stocks, they may be bid for a while, right?
Yes, and the other thing is going back to your chart, Patrick, that you showed about the different sectors. Let's not forget that there's bull markets within bear markets, and energies have done well. And then the other thing is that if you go, like Patrick, you and your members find those things and you figure out ways to grind out some returns. And it's not just as simple as everyone getting long. It's using some techniques like technical analysis and then combining it with the option trading to make sure that you limit your losses. It's not hard. It's not hard. It's not impossible to be doing well even in a down market. And I think that's the part that people should be aware. It's just because the general market is down doesn't mean that you have to be down. And in fact, a lot of the hedge fund guys that I know are doing well and are having good years.
Right.
All right.
Next question. Lena, next.
Kevin, Patrick, and Lena love the show. Greatest bi-weekly podcast in finance. While my wife and kids...
I'm sorry. That should be our new tagline.
It's
probably the only bi-weekly podcast.
Well, my wife and kids thank you for the scheduling change. I am in market huddle withdrawal. Questions. What are the characteristics of long call put that is actually cheap and has asymmetry? I hear a lot of people talking about quote unquote cheap options, but I feel they may be confusing options that are actually cheap with options that are merely inexpensive. For example, some kind of way on the money short dated call. Further, what is the relationship between the level of the VIX and the pricing of individual options on stocks and ETFs?
Okay, this one's Patrick. I'm just going to say one thing. It's out of the money.
Oh, sorry.
On the money. Yeah. No problem. It's all right.
Kev, I'd love you to kind of pine in as well on this. But the thing is that I think the key thing that I want to highlight here is that there's even one further step because for instance, going into, for instance, the December month, there is traditionally, there have been volatile periods over the holidays, but generally volatility narrows and stocks tend not to trend in big ways over the holiday period. And while the volatilities may narrow, these options may appear cheaper, and someone may say they're cheap because a 1 month option typically might have been 75 cents, and now a 30-day option going into this period might be 60 cents or 50 cents, and it appears cheap. But the question is, just because it's cheap, is it right priced or is it cheap? Because it might be the correct price for the conditions of the market, and that's what another variable in addition to options pricing, not just and this is where generally coming to the conclusion that an option is cheap or expensive, it really actually has to be based upon what you believe the underlying is ultimately going to do.
Yes. I think that's a great way of putting it, Patrick. And I guess I would talk about it in terms of implied volatility. And implied volatility is what the market expects the volatility of the security to be going forward over the life of the option around the strike price. And the thing about it is that a lot of times when people talk about implied volatility, they're measuring it against past volatility. And yes, they're not necessarily one and the same. Patrick highlighted the fact that going into Christmas time or holiday time, you get a situation.
Or going into an earnings season,
right.
Of course.
And I think the perfect example, another one is, let's just say that a company is trading, let's take a very volatile company. Let's just take Meta. All of a sudden, Meta goes and it trades at a 60 vol, let's say. I'm not sure what it trades at. But then let's imagine that we had a situation where Google came and decided to bid for Meta and was going to just pay $140 cash, like no stock, nothing. It was just going to be cash. Well, what happened to, the option? What'll happen to the options is that the implied volatility will collapse. So those might look cheap compared to before, but everyone knows that the reality is that the volatility of the security has now just gone down to T-bill plus the risk from the deal collapsing. And if we actually had a situation where there was no chance of the deal collapsing, then you would have that vol would go down to, in essence, a T-bill of volatility. Now that wouldn't happen, but the point is that future volatility, implied volatility, is the market's estimation of future volatility, and as Patrick highlighted, that is calling that cheap or expensive is putting your own subjective bias on what you think that volatility will be going forward.
One of the ways that I narrow it down, which I kind of like to do, which is rather than analyzing the historical volatility on a comparative basis, I actually look and this is why I combine things like technical analysis or quantitative things to my trading with options, is because I look at the payoff profile. I basically say, well, I believe this stock is capable of making this move. And if I can get a 3-to-1 payoff using the option, then to me, the option, I don't want to say it's cheap, but the option is right priced for me getting a good payoff profile of what I actually believe the stock is going to do. And so I usually when an option is expensive, I usually can't get a good payoff profile. And that's usually a sign for me not to touch it.
Okay. Well, and then let's just answer the last part of this. Further, what is the relationship between, there we go, between the level of the VIX and the pricing of individual options on stocks and ETFs? In general, they go together, but they don't necessarily have to. So we could have a situation where people are demanding more increased protection on the stock index as a whole, VIX, meaning that's on the S&P 500, and yet the price of individual options are not bid as high. And they call that the dispersion trade. And there's whole desks of vol traders that'll sit there and they'll try to arb the difference, because if you think about it, the stocks within the S&P 500 are the individual stock options trade on those stocks, but then it matters about the correlation between them. So in periods of high correlations, what you'll see is that the vol of S&P will go up versus the other one. Anyways, it doesn't matter. The long and short of it is there is a relationship. It's very complicated, and it'll vary based upon correlation.
All right, Nina, last one.
I think there's one more after this, actually.
Okay, well,
Really?
I'll try to be
quick.
Yeah,
wow. Two, okay.
Hey guys,
Wow.
got a question about S&P futures. What's the biggest difference between buying S&P futures versus buying the cash index on margin? How much tracking error could a trade or investor expect by continuously rolling the S&P futures versus buying and holding the cash index at the same notional? Any other sources you could point me to about some of the other nuances? Appreciate any insights you can give.
Okay, I'm going to do this one because it's what I used to do for a living. Okay, the biggest difference in terms of the short run between S&P 500 and buying the cash is the actual amount of margin that you have to put up. S&P 500 will be a very low amount. I don't know, it's 5 or 10%, whereas if you own the underlying cash, meaning the stocks that make up the index, you would therefore have to put up whatever your margin rules are for individual stocks. Here in Canada, it would be 35%. I can't remember what it is in the US.
It's 30%. Isn't it?
Yeah. And now, in terms of the tracking error, this is one of the most arbed things out there in terms of the S&P 500 versus the futures. So there is going to be very little tracking error, and it really comes down to a lot of it is based upon tax. So if you're sitting there and you're not, if you're a foreigner and you're getting dividends that are coming in from the index, then you'd probably be better off in the futures. Whereas if you're, let's just say, a big pension fund that's not taxable in the U.S., you might find that you're better off with the underlying index. One of the other things to think about is if you actually own the underlying index, you have to do the index rebalances, meaning that you have to sell the stocks that are going in, sell the stocks that are going out and buying the stocks that are going in. And it's not just as simple as that. Quarterly, I believe it's with the S&P 500, there's what's called market cap weight adjustments. So they'll find all the stock that's being issued for the various companies. So you'll have a whole bunch of stocks that you have to buy and sell based upon the changes in the share issuances. And then the other complicated part is the fact that as those dividends are come out of the index, you actually have to reinvest them. So you need to go and buy all 500 stocks with the dividend amounts in there as well, which ends up being
pain in the ass.
Yeah. So, anyways, that's something that people should just think about. It is a great question in terms of more resources.
But even how about you compared it to something like SPY versus futures, right? Like the SPY is doing that inherently built in, but then you have the management fee, I guess, of factor.
Yeah, so there's a slight management fee. The long and short of it is almost nobody should be doing it themselves. The derivatives make way more sense, and there'd just be no reason to go and own the 500. And it's actually 503. Everyone thinks it's 500. It doesn't necessarily mean that the stocks it's exactly going to be 500 stocks in the index. They have the ability to go up and down a few. Anyways, next question.
All right, last one here. It's a lengthy one. Hope my question reaches everyone in time. I find it tiresome when fan writes into a show and tells the host how enamored they are with their content. We get it. All of us tune in for the same reason. Now get to your question. That being said, I can't help myself in saying what upstanding members in the social financial community you both are, selflessly sharing your knowledge and experience to people like myself with no financial background trying to make sense of all the moving parts in the markets. A sincere thanks for your contribution. Additionally, I feel extra pride as a Canadian because you two embody so many quintessential Canadian things like politeness, a light and friendly attitude, and ribbing the shit out of your best friends. Bonus points for using Canadian parlance like hoser, holy smokes, and labat sinka. Question. I shudder every time Kevin talks about how overvalued the Canadian housing market is because I feel the same way. Is there any way to hedge out any declines in the housing market? I have a substantial amount of equity in my house. What using some of that equity to buy a fund that physically holds everyone's favorite yellow metal as a hedge? I'm talking about uranium, of course. If there's ever a time I can send some New Brunswick beer to a single address for the show, I'd be happy to oblige. I really enjoy the show. Thanks again for sharing all that you do with the community. We'd love to be able to make it out to the next piss up if there is one.
Well, now that's a very kind and lovely remark. So that's terrific. Thank you so much for writing in. And talking about the quintessential Canadian, he wants to take out a home equity line and buy uranium with it.
As a hedge, though. As a hedge.
So they're two different trades, and I really wouldn't suggest that. If you think housing's going down, there's really no way to hedge it in Canada. There are proxies that you could try. You could go try shorting HCG or one of those type of alternative lenders. It ends up being a difficult thing to do. One of the trades that I like that I've talked about is shorting Canadian banks against buying U.S. banks. I think U.S. banks are cheap and that they're unloved. Patrick's the perfect example. He shits on them all the time. And yet every Canadian owns a ton of Canadian banks and thinks they're horrific, even though they're ripping us all off. I suspect that it won't be a sexy trade. It's not going to be a trade that's going to make you a ton of dough, and it's a real capital eater.
Yeah, but it's hard. But it's hard to hedge your home based on.
Yeah, no, listen. The long and short of it is there is no way to hedge it out unless you find somebody.
I mean, you could bet on interest rates because ultimately higher mortgage rates is your biggest risk.
So,
right?
So that's another play you could do. You could say that it's going to affect interest rates, so therefore Canadian interest rates will go down more than U.S. interest rates. But you're already seeing that occur. Some people have argued that the dollar will suffer, and they've talked about shorting the Canadian dollar. The trouble about that is, what if we get Patrick's rip roaring 120 on the oil? All of a sudden, we're going to see a situation where the Canadian dollar, the loonies actually bid. So the long and short of it ends up being very difficult. I wouldn't suggest it. I think you're better off just focusing on making wise investment choices on the other side and not worrying about or not trying to time the housing market because it's difficult.
It comes down to that if you own a single home, even if it is levered up, I mean, so long as you have a stable income and can make mortgage payments, most people can weather a storm. I think those levered up ones where you own 6, 7, or even 10 different real estate properties, fully mortgaged to the tilt, Airbnb-ing them out, those people are exposed to cash flow issues that could cause them to force to liquidate. It's really if in the end you have a home, I don't know whether you should be overly stressing about hedging.
That's a great point. And I actually don't think that the pain is going to be in New Brunswick. Will it go down? For sure. They've just cranked rates. It's going to affect everybody. But the real pain is going to be in Toronto. Condos that are half built and that people, as Patrick are saying, are levering up.
Did you see that Visual Capitalist guys? We had him on before, but they did the piece showing the world real estate bubbles, which ones are the most vulnerable based on some sort of metrics. And actually, Toronto's was even higher than Vancouver's. It was like number 1 in the world.
Yeah, we've gone insane, and we have a lot of pain coming in the condo market in terms of these newly built ones. Having said that, listen, if you think about it on a longer term basis, we keep letting immigrants in, and a lot of people keep wanting to come here. And if we don't mess it up and change any of those policies and keep growing, it'll probably be fine. And there'll be cycles. And I just don't. The other thing is there's a huge transaction cost in trading your house. Like, you can't do it. And ultimately, I'm not sure that there's a proxy that you can trade that gives an ability to track housing in a way that you want without introducing more risk. Like a lot of times people go to hedge something and they just make everything worse. This could be one of those times. Anyways, thanks for the great email.
Yeah.
So if you have any questions for Kevin and Patrick, please submit your questions to nostupidquestions@markethuddle.com.
Oh, this is my time, right? I'm supposed to be ready with this. Oh, you know what? They've signed me out, so I'm going to have to wing it. Listen, thanks for following us on the Market Huddle. You know where you could check us out on all the different podcast aggregators, Podbean, iTunes, the whole 9 yards. Go talk to Lena and Twitter if it's still going. I'm not sure it will be next week. We'll see. Seems to be firing. Like he's just unplugging. At this point, it feels like he's unplugging servers to try to save on electricity. He's going to be like, shit, this doesn't do anything. Let's just unplug this one. But if it's there, if it's still working you can go check out Lena at the Market Huddle. Patrick, where can they find you?
You can find me at bigpicturetrading.com or on Twitter if it's around at Patrick Ceresna. But Kev, before I ask you to think, like it's been 200 episodes, buddy. I just wanted to thank you. It's been a great go. I appreciate that. You tolerate me.
Oh, Patrick, that you know going. What? You know what? I love Copy. I love you. I love all my children all the same. And you know what?
Lena, we have to give a shout out to
for
Lena.
sure. Lena, for sure. And listen, it's been terrific. Everyone always asks me about my experience about writing my letter and doing different things. And I always say that the one thing that I was most shocked about is how much fun and how important the show has been to me. And it would have never happened if you hadn't reached out and come and said, I've been reading your letter. I'd love to get together. And then having me on that other one that you cheat with me on, having me on that show, and then having me back on the show, which is amazing after I flubbed so bad. And then after flubbing that, you said that you want to do a show with me, which was terrific. And it's been a source of just immense joy and really important.
Yeah.
And it's been a real honor. And I just and everyone owes it to you, Patrick, because you were the one. It was all your idea. I just tagged along, and I just want to thank you for that.
But Lena's been the backbone.
Oh, that's true.
She's made the show happen.
That's true.
You would think that I would learn a thing or two, but I haven't.
Anyways, it's been wonderful. And as I said to Cuppy, I hope we have another 200.
For sure. Now bi-weekly, it's going to take.
Yeah, it's going to take twice as long. So,
so 300 is as important as 200 because we're going to. Anyway, but Kev, where can they find you?
Okay, so listen. I am not going to give you my Twitter handle. I'm going to tell you about something that I've been doing recently. I've been experimenting. First of all, you go check out my newsletter at themacrotourist.com. But if you are on Substack, they have a new feature called Chat. And I've been giving this a real go, and everyone can go and check it out. On there, it's going to be fun. It's kind people that are sharing information, and I've been giving it a real try. So go check it out. You can look me up on Substack at The Macro Tourist. If you don't sign up, you can sign up for the free one and then go to my chat and you can see all the different stuff there. So anyways, listen, thanks for tuning in, and now stick around for the after show. Okay.
First of all, let me rate the beer, and then we can talk about all of these people that came out with these.
Yes, that's right.
Hilarious thing. Thing that you did that. Oh wait, but listen, this was the most interesting beer that I think I've had in a long time, because it literally drinks almost like a port wine, but has all the profile of a beer. It's got a strange kind of cherry sweetness to it. Not strange, but it's a cherry sweetness to it. I like it. For a Belgian beer. You know what? I'm going to give it an 8.8. This is a beer that anyone that can get their hands on should try.
Well, there you go. And I think it's just because your last name means cherry.
Yeah,
we learned that. Patrick always.
It's actually pronounced. I always say Ceresna. It's like what my teacher in grade 1 called me, and that's just stuck. But the Slovak pronunciation of it is Čerešňa.
Oh,
It's it means cherry. It's some of our Eastern European.
You know what you say? That's what your teacher in grade 1 called you. I bet you she called you much worse.
But listen, we had all these people on Twitter.
Okay, let me read some more.
Like,
let me read some more. Resonance Capital coming through, and he's saying, "I know it's late, but one more may cause bibliophobia, aka fear of books." I kind of like that one. The Crypto Chills from Aussie Trader. Okay, so Tony Day has got a whole bunch here. Amidactylaxius. How do you say this name? I don't even know how to say. Their hedge fund. What's it called? Alameda?
Alameda?
Yeah. So, here's a good one. ADHD. Alameda Deficit Holder Disorder. That is awesome. That is so good. ADHD. Alameda Deficit Holder Disorder. That should have won. Unfortunately, it didn't. Won. It was too late. Unfortunately, I would have done that. Irritable bowel Bahamas syndrome. IBS. Sudden insolvent degen syndrome. SIDS. And Scaramucci. How do I say it? Scaramucci syndrome, because I think he hung out with them. Okay, here we go. I got to keep going here. FTX wallet washouts I use. Okay, let's just see what else we got here. The Almadoff with your deposits. That's pretty good from Dennis Fisher. I like that. I used the Sweats one. Alameda, I was wrong syndrome. That's Sean from Sean. Crayon Nights. I don't know who's saying that. Pyramid Fever, Bubble Hangover, Aphroditus from Macro Long Short. And I guess that's it. You guys notice anything more?
No, I think you nailed it. But it was so many. I was just laughing when I was reading through things.
Wait.
So thanks, everyone.
1 second. I got more. There's a whole bunch I missed. They were real early, and those were I screwed up. So Fred comes up with funds hemorrhagic syndrome. And then Zen Macro says side effects may include intense cravings to control world governments, Enron envy, and crypto tweeting. 75% of the tourist giggles when reading this. Well played. And that's it, I guess. Here we go. Oh, no. Finally, Freestyle Nappers had a few more. The beanbag holders rash. Polycule pimples. John radiation burns. Herpes simplex virus 2. Bankman's boogaloo. Bankman's boogaloo. All right. Anyways, did you guys know that in between the ferns?
Yeah.
With what's his face? I saw this one where they had all of his mistakes. What do they call it? The bloopers. And they were going through them all. And the one that makes me laugh so hard is when he's interviewing. Who's the guy? All right.
Matthew McConaughey.
Matthew McConaughey. And what's his face ass? When he was doing True Detective with Woody Harrelson, he said, "Are you guys sad to know that somewhere there is a sack not being hacked?"
Oh my god!
And then he asked him what the weed budget was. True Detective.
Oh,
because those two are both big pot smokers, right? So that would have been just brutal. I didn't really even think about it because they seem so different, but they're both just complete potheads, I think. Anyways, Patrick, where are you? What are you doing these days? Anything exciting?
I'm just roaming around. I'm actually heading in the morning to Amsterdam.
Speaking of pot.
Yeah.
Yeah. You can buy it legal everywhere now, Patrick. You don't need to go to Amsterdam.
I have a buddy that's there. I'm just gonna go say hi. I'm gonna.
Have you been before?
Say hi and stay high.
Actually, you know what? I've flown through there, but I have not actually gone into the downtown. And to be honest, for everyone thinks red light district, but there's so much financial history. In downtown Amsterdam. So I want to go check out where the first exchange ever was created and all the different kind of cool little historical
That's true.
sites.
I remember when we used to do This Week in History and you used to love talking about those. So you're going to send us pictures? You always say you will, and you never do, or at least you don't tag me
No.
on it.
That's not my thing. It's not
Radio
my thing.
star, radio star.
I'm a bit of a boomer this way, like where I just yeah. You know, Cuppy is like posting like every dinner
Well,
he has. and stuff like
he's
that.
a millennial.
No, but he's not.
Yes, he is. He's a
X.
millennial. He's a millennial. I
up.
know how old he is. He's a millennial.
Yeah, he's a millennial.
Yeah, he's an
What?
elder millennial.
Pretty
He's-
sure, yeah.
no, 100%.
Okay.
Definitely on the cusp anyway.
Well,
Like, see, I can't do that. I'm not gonna go like posting.
no, I know
pictures
because
of my
we're
food.
Gen X.
Yeah, like it's.
Plus,
not
we
my
just don't
thing.
care.
I don't.
We don't.
I don't.
We
But
just don't care.
listen, I'll make a point that when I see it, I'll make sure I point.
You
it out.
won't. Don't lie.
I'll send it.
Low expectations.
I do have low expectations. That way, yeah, you're not disappointed.
That was what your parents said when you were born.
Yeah.
Mine said a technical disappointment. Yours were low expectations. Lena, what have you got? Any good movies or anything you watching?
I actually finally watched the new Top Gun movie.
Oh, what did you think?
I cried at the end.
Are you serious?
I don't know. I was like, oh my god, this is beautiful.
So I don't really like. I probably shouldn't say this because I don't talk about my kids very much in terms of what they think. But my daughter loves it, thinks it's the greatest movie ever, and I'm like, really? Like it's so weird. I don't really get it.
I watched the first one first because I hadn't seen it in like I don't know
the
20
first
years
one
or
is
whatever.
so much better. It's not even close. Like I don't know.
Did you think that too, Lena, or did you have a different view?
Did I like it?
Versus 1 versus
Yeah.
2.
It's different.
Which one was
Like
Okay.
No, but like, you can disagree with this.
no, the
I
first
mean,
one was great. Obviously, a classic. But
But which one's better? I don't care which one's. They're both great. That's just
First
like a
one is
cop-out.
better, obviously.
Oh, good. Well
yeah,
done,
the first
Lena.
one is better. The second one was good too, but there are parts of it that I'm like, okay, like second one was more like, oh, they're doing a lot of tricks. Like you have different shots from the plane and all the stuff that you don't really see in the first one, right?
Yeah, that's
Like in the
true.
second
Well,
one. So you see all those
technical, the
effects.
technical effect of it is way better in the second.
Yeah, so that's that from that aspect, it was very entertaining. But overall, like the first one's obviously way better.
I'm surprised. Yeah. Well, anyways, I'm glad you see that correctly. How about you, Patrick?
I haven't seen. I've seen the original Top Gun, but I haven't seen the second one. But I'll tell you what. I did start watching something.
Okay, what did you watch?
I did. I started the series up of Narcos Mexico.
Oh, I heard people love it.
Yeah, and I finished 2 seasons of it. I've never done that.
You binged it.
Since
You
Game
binged.
since Game of Thrones. I have you know how many shows I talk about. I never watch
Yeah.
anything, like ever, and it hooked me.
Okay,
Wait, so this is
I
not
tried
the original, right? It's like a different.
No, the original is about the Colombia cartel.
because I
Right.
tried the original and I didn't
haven't
like it
seen
and
the
I gave up.
Mexico one.
But so should I
Really?
go try
But
the Mexico
no,
one?
the original one was good.
Oh, original was
No,
so good.
I like but you know what? Actually, I'll tell you, the Mexico one surprisingly started slower, and I nearly 2 episodes
almost
in,
tapped out.
I almost tapped out, and it was just from pure boredom. I didn't want to get off the couch, so I just said okay, and it's auto started the third one.
I powered through.
Might as well.
I powered through. I didn't get up. I just powered through.
I just I was like I wanted to shut it off, but it was too much effort to get off of the
Oh,
couch,
my
so I made it to the 3rd
You're
episode.
kind of like I remember the movie True Romance, and do you remember that Brad Pitt was in it and he laid on the couch?
Yeah.
That was
Oh, yeah.
Patrick.
Yeah. For that moment, and that was what did it. Because honestly, I probably would not have turned it back on if I didn't. Get
So
to the third.
once you did the third, like you would found yourself, it was 8 in, and you were like, I got to go to bed.
yeah, something like,
Like
that.
3 in the morning, and I better sleep.
I literally binge watched 2 seasons in like 3 days. It was
Whoa.
ridiculous. I've never done something like that in like forever.
Do you know what I need to-
Because even
Oh, sorry, go ahead.
even with Game of Thrones, I watched episode by episode when they were coming out. I didn't binge watch it. I haven't binge watched something for like ever. And so this is like this is my first experience in binge watching.
I haven't been
I don't
watched.
know if I like it.
Patrick's like, I haven't binge watched since Miami Vice came out with their DVDs.
Yeah. I think the last thing I binge watched was a whole bunch of James Bond movies all at once.
There you go.
Oh yeah.
And that was like a long time
James
ago.
Bond
Like,
marathon. Yeah.
yeah, I had some sort of marathon. That and like I think I watched like 7 James Bond movies in a day. That was like insane. And the other one, but like I haven't done this for a while. Anyway,
You know what you got to do?
shoot.
My son and I, we used to do the Lord of the Rings extended versions weekend.
For all in a row,
yeah.
And that's
weekend
so
because you
good.
try to do it in one
Yeah,
day.
because it's a lot. It's a lot, but it's so good.
It
So
is
good. Merry and Pippin are the stars of that whole series. Not enough attention is given to them. Like the part when the elf gives them this like special bread that's like gonna like this bread will feed like a tiny sliver of this bread will allow a man to walk for 4 days and blah blah blah, and like, they give him a loaf and then they're like, how much did you eat? And he's like, I eat all mine already. It's fucking so good. They're the best. Merry and Pippin are the best. Okay, well, anyways, listen, we should go. Thank you, everyone, for tuning in. Thank you for tuning in all the way to 200 episodes. We couldn't do this without you. We really appreciate everyone tuning in. Have a great week, a couple of weeks, folks. We'll see you on the other side.
Thanks, everyone. Cheers.